Japanese markets closed today. Also no trading in Hong Kong, though, and so as our colleague Rebecca Chung-Wilkins was telling us earlier, taking a little bit of time perhaps, maybe we have to wait till tomorrow to see a full expression of the negativity in the Asia region around that Chinese data. The Australian dollar hit by that. Also the Brent crude price hit by that, down by 1.3%. That could have an impact on some of those London-listed and other European-listed energy names. US 10-year yield, interesting that we are seeing buying of treasuries and those yields dropping, continuing that trend we saw on Wednesday, disregarding the move which was in the other direction on Friday. Let's have a look at what we've got on futures then for you. The weakness in the China growth story, very evident to see in the European futures picture. FTSE futures down 0.6%, CAC futures down 0.7%, which is in contrast actually to the US futures picture, which has looked a little bit more resilient, down 0.1% or so on S&P E-mini futures. Nasdaq futures, last time I checked, looking fairly flat. So this is the start of the European trading day then. Welcome to Monday. European stocks out of the gate, and they are weaker on the FTSE 100, down 0.2%. There's the Australian dollar move. That's connected, of course, to the weakness out of China. We haven't seen a great deal of movement in the dollar as a result of this risk on in Asia, but it isn't that extreme, I suppose, from a stocks perspective, nor in the FX markets, although we did see some money going into the yen, perhaps as a result. Here's the move in sovereign bonds we were talking about, with some buying of sovereign bonds happening today. US Treasuries a little later to open because of that market closure in Japan. So interesting to see that they open with that move in CPI in mind, perhaps, rather than the robustness of the consumer data on Friday. There's the ongoing negativity then in the European equity space. The French CAC 40 certainly down substantially this morning, down by 0.9%. We'll focus in perhaps on what's driving that in a moment. Let's move on and have a look as we continue to pay attention to weak commodity prices as well. Let's have a look at what's going on the sector perspective here. And overall then we are negative, and all of these sectors looking to be in negative territory. Just looking for things connected to the commodity story. We've got basic resources and energy, both of those looking pretty weak. The technology space looking pretty weak, despite the fact that midweek last week that seems to be doing well on the back of that CPI trade. So broadly speaking, negative across most of these sectors in Europe today. Christine Aquino joins us from our Markets Today blog. And I suppose, Christine, as expected, we see weakness across European equity markets. The timing of this Chinese data, just as we get into the earnings stories for the second quarter, is pretty weak for Europe, isn't it?
Absolutely, Anna. And again, you know, we have a lot of European companies very much dependent on that Chinese demand. And so if that is rolling over, then it really is not great news. We're, of course, going to be hearing particularly from the luxury sector this week. So I'd be interested, actually, to see, you know, if that Chinese growth story continues to deteriorate, because we know, of course, that a lot of luxury companies very much dependent on those Chinese buyers. But yeah, we'll see, of course, what that brings us. A lot of news, of course, in the region to chew through this week, including inflation data out of the UK and a few other important bits of data from Europe as well.
Okay, yes, important data from Europe. And Christine, I'm back with you as if by magic. Let me ask you about the ECB and the latest thinking there, because we've done a survey of economists which suggests that we peak at, what, 4% in September? That's a couple of rate rises still to go from here. Does that chime with what the market is thinking?
Yeah, I mean, I think at the moment we are seeing markets kind of largely agreeing with that assessment, although, again, this all depends on what we see in the broader monetary policy community and what other central banks are doing, particularly the Fed, right? Because I think the big question always for the ECB is a lot of officials still sounding very, very hawkish, but then question marks over whether they can go it alone if their peers start pulling back, particularly if the Fed starts thinking about not just pausing its current rate rising cycle, but also maybe calling an end to that, you know. And so the ECB, it's the last one out of the gate in terms of major central banks delivering those rate rises. And so the question is, will they be able to sustain that if everyone else is pulling back?
I spoke to a guest in the last hour, Joost van Linders, who joined us from Kempen Capital Management. He was sceptical that the Eurozone can deliver much growth. He says, you know, that looking at the forward indicators, he's not seeing a rosy picture. We've done a survey of economists around the UK economy, and that looks even gloomier than the Eurozone picture. So what does that conclude?
Yeah, Anna, I mean, I think the UK, it's still very much lagging its G7 economies in terms of the growth recovery from the COVID era, right? And so now what we're seeing in terms of the latest survey is that economists very much seeing UK growth lagging behind the euro area specifically. And that really gels with what we're seeing. Again, you know, a lot of problems that the UK is facing, you know, it is to some degree similar to what everyone else is contending with, but perhaps with an added layer of complexity due to various factors. I mean, Brexit, of course, potentially one of the reasons why we're in this sort of situation that's more dire, particularly on the inflation front. We're still experiencing the highest nominal inflation rate out of G7 economies, 8.7%.
Yes, I'm waiting for that to come down this week, but still with an 8% handle is the expectation, down from 8.7 to 8.2, I think, was on the Waco forecast this morning when I looked. Let me ask you about the earnings story. We're getting into the heart of earnings season, aren't we? And we're certainly at ramps up over the next couple of weeks. A number of themes will be interesting to watch. FX moves, the ongoing inflation story, the AI buzz, the cost side of things. What are you going to be focused on?
Yeah, I mean, I think that's going to be really interesting, Anna. I mean, particularly, I'm going to be watching for margins, of course, very important story. And as you say, inflation very much factoring into that. The big question really is, will companies be able to still keep passing on those higher costs to consumers? We have seen the consumer being resilient in the first half of this year and being lauded as kind of the surprise and potentially the reason why we haven't hit a recession just yet. But so, you know, that resilience of profit margins very much on the radar. And as you mentioned, the FX moves as well, especially because the dollar at 15-month lows and a lot of people calling for the end of that dollar bull run. It'd be quite interesting for a lot of companies, especially those with international markets.
Yeah, absolutely. And the pound had a really strong week last week, didn't it? More on the FX markets in a moment. We're joined by Jordan Rochester from Nomura shortly. Christine, thank you very much. Christine Aquino joins us from our Markets Today blog. You can get more from the team that puts together that blog. The front page of the Bloomberg UK website will take you to it, or you can go to TLIV Go on the Bloomberg terminal. You'll find the blog there as well. Let's check in on some of the individual stocks moving this morning. Joe Easton has an update for us. Joe.
So we're going to take a look at a couple of sectors that we mentioned in stocks to watch just a moment ago. So firstly, in the pharma space, in biotech specifically, argenx, this big shock announcement that this drug has been successful. And this is a neurological treatment for some fatigue illnesses, according to the company, and that has beaten expectations in terms of the safety of that drug. Still waiting for a price. I'm hoping it'll magically open while I'm stood here. But we can see a bit of read across over in Morphosis in Germany, getting a bid from the sector benefit there. That one's rising around 5%. Galapagos over in Amsterdam, only a small move higher, but doing pretty well nonetheless. Meanwhile, Grifols, as I mentioned earlier, that's a competitor. Some worries that this drug could now tread on their toes. We'll wait to see how much argenx moves. But meanwhile, we're also looking at the luxury goods space, completely different picture in terms of it being a very negative day. I saw some sharp moves lower in the likes of Louis Vuitton and also Richemont following the Cartier makers' earnings. They haven't been as good as expected. The China growth not quite as strong as some analysts had expected. Now, Richemont just opened down around 7%. Kering, the owner of Gucci, down 2%. As I say, LVMH and Burberry also lower as well. The other big thing, of course, is that China data much weaker than expected. GDP data, as Christine was discussing there. That, along with the Richemont weak earnings, both hitting luxury today. That is one of the worst performing sectors this morning, Anna.
Okay, Joe, thank you very much for that. Joe Easton from our equities team with an update on some of the stocks that are moving. And let's focus in on that luxury story. We've had earnings from Richemont this morning. The luxury giant reported higher first quarter sales as a rebound in Asia outweighed a decline in the Americas. The results showed demand remains relatively healthy for jewelry brands, including Cartier, despite some weakness in the luxury watch division. For more, let's bring in Bloomberg Intelligence's Deborah Aiken, who can shed some light on this. So what are the takeaways for you then from the results out of Asia? Because it's really interesting to see such a fall in the stock this morning, given there was some robustness in the Asia growth story. I suppose it comes on a day when we've got negative news flow out of China, and that makes people ask questions maybe about the next quarter.
So yeah, results 19% overall on it. So it's Q1 sales, 19% organic sales growth, 40% growth out of Asia. That was actually aligned to MODL, to our consensus. When we go into the presentation, it actually shows China up double digit, but that's against a weak base. And then triple digit growth for Macau and Hong Kong. So that suggests that at the very high end, we are seeing tourists booming into Hong Kong and into Macau. It's not just in Hong Kong domestic driven. That's very strong. We also did see from Asia, we're starting to see in those Europe numbers, Chinese tourists into Europe. So that's a positive. But overall, in the way that Richemont has run, and given that this is against a huge comparable base, across all regions. We've got double-digit growth mostly everywhere, but it's a huge comparable base, so the market's expecting a little bit more.
So it's just a victim of higher expectations then on this day. The US seems difficult to read, perhaps then. Deborah, how should we analyse what we've heard out of the United States for Richemont, and what to expect for the year ahead?
So we have a single-digit decline in Americas overall, and no breakup yet of the US number. But we do know that it's softening in the US. We were expecting it to be softer in the US. It's against a huge comparable, a high 20s year ago comparable growth rate, so we need more visibility. We'll be looking at Asia, jewelry, and own retail, which have very high margin growth, and they're where the biggest growth areas are, and that's where the margins are highest, to prop up investment into the US and any other countries where there's a slowdown.
Yes, colleagues talking about an unexpected decline. Well, at least the Americas revenue growth decline, signalling US weakness, as you say. We'll wait for more detail on the breakout there. So jewelry, again, a bit of a strong point then. How does that compare to others?
Very strong. So jewelry is the shining star. We are seeing that Cartier, for example, will do a lot more in e-commerce, because e-commerce was actually a little bit weak, but we don't know for which brands this quarter. We know that there's a return to stores, so that's a part offset, and their own retail is 68% of business now. So that's very, very strong for them too. But for jewelry overall, we're expecting some new designs. We have some new stores open, we have new pop-ups, new events, lots going on, and we think some of the margins, some of the profitability that will come through this year will be reset into jewelry as well. For Asia, we must watch out, because that 10% growth we saw on watches, there's a high exposure to Asia. So that will give us some telltale on how China's doing and at what level the growth comes through for next quarter.
Interesting. Deborah, thank you very much. Thanks for joining us. Deborah Akin from Bloomberg Intelligence with a focus on the luxury sector. Coming up on the programme, after last week's dollar slump, the bears are gathering with calls that the currency is set for more losses. We'll get the Nomura view. That's coming up next. This is Bloomberg.
What do you like most about your job?
I think the people. I mean, ultimately, we're a people business. A lot of what my job is as CEO of the company is to give those people sort of motivation, to tell them where we're going, to encourage them to come up and do their best work, to encourage them to collaborate. Sometimes you sort of think you're almost a psychologist, as you are a business leader, I think, sometimes.
And so what's your best piece of advice?
I love pitches. I love being sort of leading from the front, if you like, and spending times with teams. I love to see the work that we're doing. When we pitch for a piece of new business, often when we come together. So I guess I try and put myself in the seat of the client. Now, what's the client going to think when they see this work? Are they going to be excited? Is it going to turn their brand around? How's it going to resonate with their consumers? So as much as possible, I think probably I'd try and play that role.
Three prime ministers, 4 chancellors, an energy crisis and the soaring cost of living. It's been a hard year for startups, but even in the toughest times, some of the best ideas are born here in the UK. Bloomberg UK's Startups to Watch will profile the brightest companies under 10 years old, with the winners unveiled at the Bloomberg Technology Summit in London in October. Get your entry in by the 7th of August for the chance to have your company profiled and to attend unique networking events. Good luck, and we hope to see you there.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
This is Markets Today. We are 14 minutes into your European trading session. Negative across European stocks, perhaps pulling back from the extremes of negativity we saw just out of the gates at the start of the trading day. The Chinese sentiment seems to be weighing on European stocks a little more than it's weighing on US futures. Nasdaq futures up 0.1%, E-minis fairly flat. Let's return to one of the big talking points of last week that continues to be on the minds of many investors. A number of strategists and investors think a turning point has been reached for the dollar after the currency had its worst slump since November last week. Standard Bank, BNP Paribas, and our next guest are among bears seeing a heightened risk of the dollar weakening further. Let's talk to Jordan Rochester, G10 FX strategist at Nomura. Jordan, very nice to have you with us. So, many people calling the data last week, the CPI print, a game changer and either adding to or turning toward weak dollar views as a result. You seem to be among them, at least in terms of the weak dollar view. How weak can it get from here?
Well, we're looking for big moves to come. Dollar yen down to 135, euro dollar up to 114, perhaps 116 next year. These are the sort of dollar moves that you get probably once a year. It's once or twice, that's it. And you have to be on your ball. You have to be ready for it. Because the first 6 months of the year left everyone very red-faced, to be honest. As red as a beetroot. You had a 6-month price action of a zigzag, and it caught everyone up into these small momentum trades. People went long euros, got caught out. They went short euros, got caught out. This is the moment where we think there's going to be a big decline in the dollar, thanks to the market seeing weak inflation, annualizing less than 2%. That's below the Fed's target. It's 1.92 or whatever it is. That opens up the door for markets to be aggressively pricing Fed cuts next year. Okay, so then aggressively pricing Fed cuts makes me think that there is quite a lot of dollar downside in your view then. Goldman Sachs then saying that the dollar downturn will be shallower than in past cycles because of the economic resilience that they see. Is that an argument that you're working into your thinking as well? I'd flip it slightly. It's because of the lack of manufacturing growth around the world. You look at manufacturing PMIs, it's awful. So the likes of China data this morning, pretty underwhelming as well. A lack of big fiscal stimulus out of China makes it really difficult for the dollar to massively sell off. So something in excess of 10% seems unlikely. To get that, you need a big fiscal boost or a big monetary easing in the US. We're looking for the monetary easing side, so that helps the dollar next year. But for the fiscal side, it's quite limited in China at the moment. But if that was to change, so 2024, it's a long way away, if we saw something next year, then it really could lead to further dollar downside. What's the next big catalyst you're watching for then on the dollar? Because Morgan Stanley talking about preparation for a rhetorical policy pivot. We were, my colleague Valerie Teitel and I were talking earlier on, she's looking for some real weakness, some real cracks to come in the labour market story in the US. Which of those do you think takes the argument further, pushes the dollar down further? Well, look, it's a short, in terms of US events this week, it's quite limited. It's retail sales. We have a podcast called The Weekhead at Nomura, and it's quite useful to keep you up to date what's coming up. This is UK Inflation Week. Yes. But retail sales in the US won't move the needle. Next week is the Fed. This week they're in blackout, so we won't hear from them. So at the meeting next week, we could see some sort of pivot. We think it's going to be the last rate hike of the cycle. But what's the straw that breaks the camel's back is the labour market. And And we started to see some signs of cracks emerging. Initial jobless claims started to pick up a few weeks ago. Then it's reverted back down again. So those cracks were there, then healed themselves slightly. So we're not there yet.
How much of a pivot could we get this month? Because don't you think that through the summer they might want to maintain some optionality into the autumn, into the fall?
Well, it depends what language they choose in the minutes. We'll probably see something like some members or several members suggest that this might be the end, but it won't be a consensus.
Right, so that sounds like sort of a bit of a soft pivot rather than a sort of big sort of Powell-endorsed announcement.
Well, a hard pivot is when things really go against the wall, and that's when you get a negative non-farm payrolls number. The day we get that, and we just had the first negative surprise in 15 months, so that's kind of why it's fueled this dollar weakness. It wasn't just CPI that drove it. If we got a negative NFP, which we think we'll get sometime late Q3, early Q4, that's the moment for the really strong pivot where the market will only be looking for rate cuts, potentially not rate hikes anymore.
Okay, let me ask you about European currencies. You mentioned that this is the week where we get UK inflation, and it is expected to come down, but still have an 8% handle, which is quite an outlier then in terms of the big trading blocks that you might compare it with, at least, although within the Eurozone there are certainly areas of high inflation still. Let me ask you about what you're expecting to see there and what that does to the pound, because the pound had a really good week, but part of that was a weak dollar story, wasn't it?
Yeah, absolutely. The advice we're giving to clients is don't sell cable, so sterling against the dollar, don't do it, because the euro-dollar view, the dollar yen view, the broad dollar story, that'll help cable head higher, so 135 is quite possible. But we are short sterling via the euro this week because we're hoping to see finally the peak of services inflation in the UK. Now, we've seen it before. We saw UK services CPI peak out earlier this year, went back down, then it re-accelerated again. We're not sure whether it's a Beyonce effect, whether the leisure and services recreational went up because she played here, Harry Styles is playing, who knows. But if we see some payback, we're looking for 0.1% payback, very, very small. But if we get more than that, it really is a sell sterling moment, but against the euro and other currencies.
It's a strange world we live in where we have to keep across the sort of concert dates, don't we, as well as the central banking dates, Jordan. Let me ask you about the yen, because there's a big focus there on the BOJ this month, whether we see any change. Are you expecting any policy change at the BOJ?
The BOJ is a tricky one to forecast. It's a human reaction function at the end of the day, but we do expect some change. So it could be on the yield curve control. Does it move from the 10-year down to the 5-year or even the 2-year part of the curve? The markets are kind of prepping themselves up for this, but we got much more excited about it in sort of March and April time, and investors were disappointed. So it's possible we could be disappointed again, but Japanese inflation's this week, and if that comes in strong, if core comes in strong, it's been rising for the past few months, then that really opens the door to potential change at the Bank of Japan.
Yeah, that Japanese inflation print in the diary for Friday, isn't it? Jordan, thank you so much. Really good to get your perspective. Lots of FX stories to cover this morning. Jordan Rochester, G10 FX strategist at Nomura. Joe Easton was giving us a heads up to what could be a big move and has been confirmed as a big move on one particular stock this morning. That is argenx. This is a biotech business. Some good news out of one of their drugs trials, and that stock up by 21.5% this morning. So we'll continue to watch that business and indeed the sector, because it's had negative impact on some biotechs and positive impact on some others, as Joe was talking us through. More from Joe in 10 minutes or so. Coming up, Moscow moves to take control of more European businesses operating in Russia. We'll have details next. This is Bloomberg.
Race relations in the United States are much better than when you were growing up in Mississippi, or do you think we've made less progress than you think we should have made?
Both. I think they're much better than when I was growing up. There's so many people who occupy areas I never thought I would see them in. But I would have hoped it would be better. It's been a lot of progress. And somehow we're in an era now where, in spite of the progress, race relations in certain areas has become very scary. You know, some of the things that one reads about now remind me of growing up in Mississippi.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
This is Markets Today, 23 minutes into your European trading session, and the picture for European equities is a weaker one, down by around 0.3%. Actually, we saw European equity markets a little weaker than this right out of the gates, but still down by 0.7% over in the French market. Let's talk about some of the businesses. Well, one business is listed in France and some others. An interesting corporate story for you. Russia has seized control of the local subsidiaries of France's Danone and Denmark's Carlsberg under a decree by President Putin. The move was aimed at companies from what Moscow called unfriendly countries. I'm joined now by Dasha Afanasieva, who is Bloomberg's European consumer goods reporter and can give us an update here. This is a really interesting story. Not a great deal of impact on equity markets this morning from the stocks we just showed on the screen, both of them down, but not substantially. So do I take from that that this was expected? I thought both of these businesses either had sold or were trying to sell these companies.
I think that could be why they've run into trouble, because they were very close to selling. It was unexpected in the sense that a decree was brought in back in April, and there have been other tightenings from the Russian government that made it increasingly difficult to operate over there. But Carlsberg said that this was unexpected, and they're now assessing the legal implications. So it was to a degree priced in, because there were already write-downs announced, but still quite shocking, particularly for the companies still operating in Russia.
Yes, and when you talk to some of these companies, they talk about, yes, the write-downs and the selling of the assets, but they also talk about the people that they employ there, and that is something that obviously in this situation they'll be thinking about a great deal. So what are the implications for other international companies that are still operating in Russia? We focus a lot on the ones that have sold their assets, but there must be some that are still there.
In reality, in the consumer goods sector, the vast majority of international companies that have big operations in Russia, companies like Mondelez, companies like Nestle that have factories, have stayed. And they've said things like, we're only going to produce essential produce. But they're essentially now, maybe looking quite nervous, because this isn't just about companies wanting to leave. Restrictions on companies trying to leave, such as paying a massive haircut to the Russian government or finding very specific buyers, those restrictions already existed. But this decree, I think, could affect companies that are just wanting to reduce headcount or wanting to change their operations. Things do become a lot more unpredictable and difficult for companies that have been doing this balancing act between not upsetting the Russian government too much and also not upsetting the international community.
Yes, and as they would argue, some of them do provide those more essential products. In their view, that's the reason to stay and do that and do some of their previous business. Dasha, thank you very much. Dasha Afanasieva, Bloomberg's European consumer goods reporter. Coming up on the program, go slow. We will discuss the policy implications from today's disappointing China GDP data. More on what that means for China. Expectations of stimulus still to come then. To what extent should we cling to those expectations after this data set? We'll talk about that. There's clearly something that's weighing on European corporates this morning. This is Bloomberg.
of politics
We're not going to be relying upon countries whose values we don't share.
to the world of business.
It's all about corporate power in the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We're going to be more excited what's in store for you.
How long will it take? How many years? Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern
It's the one area, really, of bipartisanship.
I think we're getting more of it.
That's optimistic.
and Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee
The
Langs.
door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
That
it.
really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most. This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure. With two more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers
Right.
that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority. The markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis, weekdays.
This is Markets Today, 30 minutes into your European trading day. Here are your top stories. Alarm bells. China's second quarter growth disappoints and retail sales underwhelm. In the latest sign of the nation's sluggish recovery, Asian stocks and futures fall. Too early to talk tariffs. U.S. Treasury Secretary Janet Yellen calls for further de-escalation of tensions with Beijing, but says it's premature to discuss trade. Janet Yellen will join Bloomberg TV exclusively later today from the G20. Plus, shares of Cartier owner Richemont slump on an unexpected decline in North American sales, despite strong demand in Asia. Let us have a look at where we are across European equity markets then, and you see the effect of Richemont playing out quite strongly here. We are weaker across European equity markets. Stocks Europe 600 down by 0.3%. What is interesting is the weakness over in Paris today, down by 0.7%. So actually that falling quite a bit more than the indexes that you see on your screen, the German and the London market sort of downplaying the negativity there. And a lot of that negativity in Paris has to do with the read across from consumer products and services. Richemont is falling elsewhere over in Switzerland, and so that is having a downward impact on some of the luxury names. We see Bruno Cucinelli, Hermès, Christian Dior, LVMH, all trading pretty negatively, and some of those are really heavy weighted. The ones that are French, of course, some of them really heavily weighted in Paris. Let's take a look at the sectors then, and as I was saying, that's where consumer products and services is where we have been seeing quite a lot of negativity. That and basic resources, which does make sense on a day where we're quite nervous about the Chinese growth story. That is having an impact on basic resources prices. Commodity prices have been weaker. Both oil prices down over more than 1% on Brent, and iron ore I noticed was weaker through the Asia session. Telecoms and healthcare are positive, but these are the more defensive end of the spectrum, of course. Let us get an update on the individual stocks that are on the move. Joe Easton has a briefing. Joe.
So Argenx is the big stock getting us all excited today in terms of the rally. That one rising more than 25% over in Belgium and also boosting a few other peers. Interestingly, one of its rivals, this is a company in Spain called Grifols, dropping around 2% with concern that this drug that Argenx have announced data on this morning could actually take some of their market share. It could treat as many as 12 illnesses, according to some analysts. So that's the big mover in healthcare today. Meanwhile, those luxury stocks that you mentioned really weighing on the French index. We don't normally see drops of this magnitude in the luxury goods stocks. Richemont, that's down the most since May 2022. So more than 14 months for that one. Hermès, Bruno Cucinelli over in Italy as well. And LVMH down 3%. It's a big move for that one, and that's one of the biggest weights on the CAC 40, as you said there. Just in terms of some other decliners that we're going to have a look at today, we've got a trading update from Ocado due out tomorrow, and people are a bit nervous about sales slowdown there. That one's down 3.5%. Ericsson continues the slide that we saw last week following those weak earnings. Barclays downgrading that stock today to equal weight. Meanwhile, a Coca-Cola HBC, the bottling company, some concern that their assets could be targeted by Russia, in line with the previous reporter that was speaking about that. And Anglo-American, finally, the mining space, representing that weak GDP data hitting the mining stocks this morning. That's the worst performing mining company today, and one of the worst ones on the FTSE 100, down almost 2%.
Okay, Joe, thanks very much. From our equities team, Joe Easton. Yeah, really interesting to watch those companies that do have operations still linked to Russia, and how the latest moves against some Western businesses by Russia might read across. Thanks to Joe for the update. Right, let's talk about China's economy, because here we've seen a slower growth story. The growth numbers coming in slower than expected in the second quarter, with worrying signs of a slowdown in consumer spending and ongoing pain in the property market. The mixed data has prompted calls for Beijing to do more to support the recovery, and mixed because we did see some areas of brightness around fixed asset investment and industrial production. Bloomberg's China government and economy editor Jill Decis joins us. Jill, help us understand the numbers. Break it down for us.
Sure, of course, Anna. So yes, first of all, I think it's important to look at that headline GDP figure, 6.3% growth year over year for the second quarter. Now, that looks kind of, nice on the surface, but you have to remember that that's comparing to an incredibly difficult 2022 when Shanghai was in lockdown. We saw a lot of other restrictions across the country. And so really there was a very low base of comparison for this number to be compared to. And ultimately, even then it missed estimates. Economists were thinking that that year-on-year figure was going to be 7% or more. The other thing, too, is that if you look down a quarter-on-quarter basis in China, you saw growth of only 0.8% in the second quarter from the first quarter. And again, as you pointed out, some of this data has been pretty mixed. Some of that industrial production data was a bit stronger than we were expecting. But then you look at that those retail sales figures, 3.1% growth year on year in June. I mean, it's really kind of looking like we're seeing a slowdown in the type of consumer spending, the consumption that was really driving the recovery earlier this year. And that, coupled with all else we know about the sort of the waning household business sentiment in China right now, it's really just not looking like a very good picture.
Jill, thanks very much. Thanks for the update. Jill Decis in Hong Kong with the latest on the China story. And it is that China story that in its different forms is weighing on sentiment, it seems, for European stocks, in particular luxury names. Now let's talk about what's been going on in the banking sector. Another area of the earnings story to focus on. Wells Fargo earned more net interest income than analysts expected in the second quarter and lifted its guidance for the full year. This as big US banks continue to benefit from the Fed's rate hiking cycle. Wells Fargo CFO Michael Santamassimo told Bloomberg he's happy with the bank's performance.
We're relatively small, compared to some of the, the big peers out there. But it's something that we've been focusing on now for the last few years, and just really making sure that we're consistently adding the right people. We're investing in technology, and really the focus is to just support our clients better. It's focused on the U.S.-based clients for the most part. There's some outside the U.S., but really primarily here in the U.S., and it's just supporting our corporate clients and our asset management clients and others just better and better each day incrementally. And so we're happy with the performance we had this quarter and last quarter, and I think that shows through the fees. But it's something that we'll just keep gradually building on over time.
Mike, let's talk about commercial real estate, because it caught a lot of eyes that actually Wells Fargo increased the allowance for credit losses by about $950 million, and it was commercial real estate office loans that were cited for the reason behind the move. So as I understand it, you haven't seen significant losses yet, but you had CEO Charlie Scharf say that you expect to see it play out in that market over time. When are you anticipating to see peak pain for commercial real estate?
Well, I think I would just broaden it a little bit first, and I'll come back to office. And when you look at the overall credit picture, it's quite good. On the consumer side, we're seeing a little bit higher charge-offs, but that's off historic lows. And so, that's actually performing quite well so far. And broadly on the commercial side of the business, it's going quite well in terms of both the our middle market and commercial banking clients, and big chunks of the commercial real estate portfolio are actually performing really well so far, particularly given where we are in the cycle. And so really this conversation is focused and isolated on the office portfolio. And I think as you look at office, it's a lot of the trends that we all are talking about now for a while in terms of return to office, companies needing less real estate, and that's starting to come through in different cities and different properties across the country. And what we did today, or in the quarter, is make sure as we sort of look at all the things that we can see and then think about a whole bunch of different scenarios that we stress in the portfolio, and so we built a reserve that we think is appropriate to deal with a number of those scenarios. But keep in mind, we haven't, as you said, we haven't really seen the losses be significant so far. But there will be some weakness over time, and it will play out over an extended period of time, and likely years, not months or quarters, as people work through the changing patterns and different issues with individual properties.
That was the Wells Fargo CFO speaking to Bloomberg's Romain Bostick and Katie Greifeld. For more on the US bank earnings story, which of course has part played out and part still to come, our Bloomberg banking reporter Stephen Aarons joins us from Frankfurt. Stephen, very nice to have you on the program. So the dust has settled a little bit on those JP Morgan numbers and the numbers from the sector as a whole on Friday. They seem to go down well initially, but then fade a little. Now the dust has settled. What do you make of it all?
Well, I do think those numbers, especially from JP Morgan, were really good. I mean, look at net interest income. We just heard you talk about it. And it's amazing. They had $21 billion in net interest income. I mean, that's up 50% on just a few quarters ago. They did say it's going to taper off at some point, but that alone was really, really strong. There was a bit of weakness in the investment bank, but that was expected. And there is a focus in commercial real estate. But overall, I think those were really good numbers.
Okay, so good numbers. It's another big week for US banks this week, Stephen, in terms of the earnings story. What are we going to be looking out for?
Well, the trends we were just discussing, most of the banks, including Goldman Sachs, have flagged continued weakness in investment banking. The M&A market continues to be really, really bad. Trading is not at the level we saw last year. Income, net interest income will be a big boom at banks. Goldman, not so much because they rely less on it, obviously. And there will be further questions about commercial real estate, especially the office part of it that we just heard the Wells Fargo CFO talk about.
Okay, Stephen, thanks very much. Bloomberg Steve Aarons joining us there from Frankfurt with the latest on the banking sector. Coming up, global finance chiefs kick off 2 days of meetings in India. We will get the latest from the G20 summit. We've already heard from Janet Yellen, her hopes that better mood music around China can deliver. We will be hearing from Janet Yellen a little bit later on. What will be part of that conversation? We'll get a briefing shortly. This is Bloomberg.
I don't think we can replicate Tesla. Tesla is unique because when they found it, and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but Xpeng is Xpeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
Our studios in New York and San Francisco. Our expert hosts have the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg. Bloomberg Television, your global business authority. Information you want, analysis you trust. Everything you need to get set for the start of U.S. trading. Watch Bloomberg The Open with Jonathan Ferro. Weekdays on Bloomberg. Season is here.
You're going to see cracks start to emerge. This earnings season could be a little bit choppy.
This is going to be an earnings season mystery. Bloomberg breaks the numbers first.
Those earnings just crossing the wire.
Up by 25%.
Absolutely blew out of the water expectations.
With exclusive expert analysis.
We're starting to see earnings recovery emerge.
AI will be a huge boost of revenue growth.
We're not going to see the same follow through in terms of the price reaction.
Second quarter will be where the rubber meets the road.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
This is Bloomberg Markets Today. We're 44 minutes into our European trading session, and you can see that we are down across European equity markets, but actually not everywhere, and pulling back from earlier losses. So we were down much more substantially than this earlier on in the trading day. We now see the CAC 40, which is the worst performing market, down by 0.6%, have been down as much as 7 or 8 tenths earlier on. So pulling back from those earlier losses, and the FTSE 100 now in positive territory. US futures flat on E-minis, Nasdaq futures up 0.2%. Let's get to the morning must read this morning, and this morning we've picked out one of our opinion columnists' pieces, this by Matthew Brooker, our colleague here at Bloomberg, who's talking about short selling and short selling rules being changed in the United Kingdom. He says that the UK is making life easier for short sellers, in particular reducing the need for individual disclosures around short selling positions, and this was something we touched on last week in connection with other broader changes to the post-Brexit financial services regulation here in the UK. He says this is a big test of Brexit freedoms, and this is how the Brexit dividend, if it is ever to be found, will be found slowly and incrementally, because he analyses, he comes to that conclusion because he looks at the extent of the changes planned here and says they are pretty small. It's not the stuff of revolution, but maybe that shouldn't surprise anybody, because the UK was, of course, crucial in the shaping of financial services policy whilst it was a part of the European Union. So interesting to see Matthew's take on these changes and how substantial or otherwise they will be. Now, the EU's Commissioner for Economy, Paolo Gentiloni, has told Bloomberg told Bloomberg that Europe is not suffering from stagflation. Gentiloni was speaking exclusively to Bloomberg's chief international correspondent Haslinda Amin in India, where finance ministers and central bank governors are meeting for the G20 summit, and Haslinda joins us now. Interesting conclusions from Gentiloni then when it comes to the European growth story. What are the themes you're talking about there at the G20?
Well, growth obviously is front and center. We're hearing from a lot of the leaders here that as much as, China's growth is slowing down, they're finding ways to counter that slowdown. Engaging India in a bigger way is one way, and that is proving to be beneficial for countries like Indonesia, which says that, their GDP for the year will be intact at 5%. That is an overriding theme. Also, inflation, the theme of inflation front and center, but there's optimism. The fight is going in the right direction. You talk about our conversation with Gentiloni. He says, 2% or near 2% inflation could be reached by 2024. So there is optimism out there. Anna, we've been talking a lot about all the negative news out of China and the rest of the world, but take a listen to what Janet Yellen herself had to say. She was optimistic, pushing back on the idea that the tensions between the U.S. and China could get worse. In fact, she's saying to look for ways to further de-escalate tensions between the two sides, though the caveat is that when it comes to, those trade restrictions, trade tariffs imposed on China, that's not an area they're looking at. That will take some time. Both sides pretty wary when it comes to trade with each other, and it is premature to think about an improvement in that area.
Our expectation is that the headline inflation will decline slowly, not with the speed of headline inflation. Core inflation will be slower. So this is, I think, because of the fact that headline inflation is influenced by energy prices, and the core inflation is influenced by the increased prices, wages, services, So a mixed situation, but overall, I think we will have in 2024 the level of inflation near to our targets.
So inflation has peaked, underlying inflation has peaked for Europe.
For sure.
Is stagflation the right word to use to describe the European economy right now?
Well, listen, we still have growth, weak growth, of course, slightly weaker than expected in the first quarter and probably also in the second quarter. But if we look to the last autumn, we were expecting a real recession, blackouts, energy problems, supply problems for energy. These risks didn't materialize. I'm not saying that we don't have any risks ahead of us, because indeed tightening of monetary policy will produce impact, and also the energy transition. We are not completely out of the woods in Europe. We made a miracle in going out of the dependency from Russian fossil fuels, but it will be a challenge also for next winter. Overall, I would say we are not in a stagflation situation. We still have growth, and we expect in 2024 to have stronger growth. And we have an incredibly resilient labor market.
So optimism for the European economy, according to Gentiloni. But you know what? I mean, yes, there's a lot of optimism right here. But Anna, in the days ahead, there'll be lots of big issues that need to be addressed, in particular debt restructuring. I mean, more than half of the countries in the world are either experiencing a debt crisis or close to being in one. That's a huge issue that needs to be addressed.
Haslinda, thank you very much. Bloomberg's chief international correspondent Haslinda Armin on the ground for us at the G20. We'll be hearing from Janet Yellen, of course, at the G20 a little later. Coming up, the UK is seen growing slower than its European counterparts next year. We'll talk UK markets ahead of this week's CPI print next. This is Bloomberg.
Everybody want to be a consultant, and what are all these consultants doing?
Well, David, I think that we actually defy the label consultant, because sometimes consultant seems to imply that we only give advice. And when you look at what Accenture does, we're really different than the traditional version of a consultant. We're really about relevance and results, and that's what is driving our business.
What about a consulting project? In my example, I'm the CEO, I have a problem, I call you up, I say, solve my problem or give me a solution.
We don't operate as big companies permanently in crisis mode. And so when you think about, like, how long does it solve things, a lot of it starts with, you know, the company being willing to set aggressive goals. And so what we are trying to do now is work with our clients to work differently and to work faster.
This is Markets Today. We are 53 minutes into our European trading session, and we're negative, but not quite as negative as we were. That's the silver lining story, if you like. Down by 0.7% on the CAC 40, I still see. Weighed down by what's going on with luxury stocks today. Richemont, where the story started, but in the French market, we see it expressed by weakness in LVMH and some of the other heavily listed luxury goods names there. Let's talk about what is happening in the markets today. Our markets reporter, Valerie Teitel, joins us. Valerie, so lots of negativity around risk assets as a result of the China story. But looking ahead, well, back and ahead, I suppose. The UK very in focus this week because we have inflation data due out the middle of this week. And last week we had real strength for the pound, but a lot of that was actually dollar-driven, perhaps. So what are your thoughts on the pound then as to whether it's a fade from here?
Well, look, I think that the UK is really going to be taking center stage this week. The CPI print on Wednesday is going to be the biggest one for macro markets. And it's really interesting, you know, with the pound having its best week of the year, it's really, you know, almost you want to set it up as a fade, to fade the strength in cable. But, you know, the one thing that makes me hesitant to be in that position is a lot of the move last week in UK gilts was dragged by this rally in treasuries. We now have a terminal rate of the Bank of England down to 6.1, 6.2%. You know, it got as high as 6.6% only just 2 weeks ago. If we get a hot CPI print on Wednesday and we see these interest rate differentials diverge again, knowing that the Fed is unlikely to hike again after July, this interest rate differential could continue to widen in the next few months. Maybe that could be a bull case for the pound from here. But then remember that last hot CPI print, Anna, we had that interest rate differential widening and the pound actually weakened because again, we're getting to some point where perhaps the Bank of England is going to have to hike so high that they damage the UK growth prospects. So it's really a difficult one to figure out into position for this week.
Yes, and your hesitancy around going short the pound at this point, also echoed by Nomura. I spoke to Jordan Rochester and he was also saying that's not the way he would express pound weakness. He would look to the euro pound trade for that. Let me ask you about also another UK theme. The UK OBR saying this decade is a very risky era for public finances. This is something that we had flagged to us last week, but in focus for you. What are your thoughts on this?
Yeah, so if this narrative picks up steam, Anna, I think this would be the real negative trade for sterling, for cable, for the pound. That was the last Thursday. The UK put out this. The UK OBR put out this big report calling the debt profile of the UK government unsustainable and deteriorating. Also saying it's a very risky era for public finances for the UK government. So let's say we have a situation where the Bank of England really does have to go to 6.5%. That's going to cause some real big questions over, do we get to some sort of unstable trajectory that causes almost a huge blip in the gilt market, very clear to like what we had last September.
We've seen those, yes.
You know, could that perhaps cause some issues for the Bank of England and reining in inflation when you get to this real debt dominance, fiscal dominance story? Because let's be honest, out of all the economies in the world, the UK closest to entering that situation.
Valerie, thank you very much. Bloomberg's Valerie Teitel with thoughts on UK assets this morning. That brings this hour of programming to a close. That is it for Markets Today. You can get insight from us and the team that puts together the Markets Today blog. Go to the Bloomberg UK website. You'll find a link to the blog, or you can type TLIV Go onto the Bloomberg terminal. European equity markets are negative this morning, but off earlier lows. The pulse is up next. This is Bloomberg.
The deal was the brainchild of Apollo CEO Mark Rowan. In January, Apollo closed its $11 billion all-stock merger with Athene Holding. It had already owned 35% of the insurer. Here's what Apollo gets out of the deal. Assets under management. Apollo expects them to double to about $1 trillion by 2026. Much of that projected growth will come from the merger, and those assets are especially attractive to Apollo. Insurance companies typically go after much more modest returns than buyout investors. That will give Apollo more options for investing the cash. Athene is a steady provider of fee income. It has grown into one of the nation's biggest holders of fixed annuities, those retirement savings products favored by risk-averse customers. The merger will also allow Apollo to simplify its governance. It gave up its dual-class share structure and adopted a one-share, one-vote plan. The hope is that will eventually lead to Apollo's inclusion in the S&P 500. How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
This month, Bloomberg brings you the latest from China's 14th Annual National People's Congress, including China's COVID recovery, economic outlook, and geopolitical tensions. Continuing coverage this week on Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield every Friday at 1 p.m. Eastern, right here on Bloomberg, your global business authority. Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London with the conversations that matter, and here's what's coming up on today's program. China's second quarter growth disappoints amid poor retail sales and the latest sign of the nation's struggling recovery, prompting more stimulus calls. U.S. Treasury Secretary Janet Yellen calls for further de-escalation of tensions with Beijing, but says it's premature to discuss trade. Well, she joins us exclusively from the G20, plus Richemont shares slide after the Cartier owner reports an unexpected decline in sales from the Americas. Demand in Asia rebounds. So welcome to the program. Let's take a look at the European markets map. The picture across the board, of course, is many companies reporting earnings. I think we're expecting 9% drop in the S&P 500 in the U.S. And if you look at some of the European impact, so this is what's coming up. It doesn't mean that everything's a black screen because we don't have market prices. We do have market prices, and here they are. A little bit of unchanged for the FTSE. You can see the DAX down 0.1%, the CAC 40. Bit of concern maybe about the luxury stocks because of those concerns about how much Richemont sold in the U.S. But the bigger picture, of course, is not only what's happening globally because of this earnings report. So we have many companies reporting in the next 2 to 3 weeks. I think our Bloomberg Economics went through the numbers and say that in terms of the percentage drop, they're expecting a 9% drop in terms of earnings per share in the U.S. The European stock market could be even lower, some 12% in terms of earnings per share. Now, the other big story is, of course, China's economy growing slower than expected in the second quarter, worrying signs of a slowdown in consumer spending, also ongoing pain, of course, in the property market, prompting a lot of traders expecting Beijing to do a bit more. And then the youth unemployment is what our Valley Titel decided to focus on because it's another record high of 21.3%. So, of course, if you have a balanced economy, this is one of the things that they really need to take care of. And then the dollar. Is this the end of an era? Now, we're seeing dollar weakness from quite some time. Dollar's busted bull run has strategists and investors saying the turning point is in hand. And of course, this has huge consequences, not only for financial markets, but global economies. And so, for example, some of the ripple effects that we've been looking at is reducing import pricing for developing nations, some of the popular strategies that have worked so far tied to a weaker yen,
but also boosting U.S. exports at the expense of Europe. Those are some of the impact that we could see if the dollar slide continues towards the end of the year. So the yuan and Chinese stocks lower this morning after that data from China painting an image of uneven economic recovery. Now, the country's youth unemployment rate hit a record in June. GDP and retail sales came in below estimates, as we were just saying. Joining us from Hong Kong, Bloomberg's Jill Dices with the very latest. So, Jill, good morning. There's a call for stimulus. It's growing bigger and bigger, but will we actually get it?
I don't really know that we're going to get any kind of massive stimulus out of China right now. It seems like the government is really focused on this idea of very targeted types of support. There's been several economists who have floated the idea of maybe some new fiscal measures to try to help stir the economy. And ultimately, I mean, it might be something more similar to tax incentives or maybe an extension of additional sort of property-related targeted measures that we saw like last week when there was some loan relief extended for developers. That seems to be more of what's in the cards right now, because what this data showed us today was that the economy, while growing quite significantly year on year, that 6.3%, remember that compares to a very, very, very difficult 2022 when Shanghai was in lockdown. A lot of cities were sort of restricted. And so ultimately, while that number looks very nice, it's still less than what economists had expected. We did see that slowdown in retail sales growth, kind of hints to the consumption-driven recovery being faltering a little bit there. We've also seen that reflected in prior numbers on sort of weakness in household and business confidence. And then, as you mentioned, the youth unemployment rate just continuing to stick at those highs right now all indicates that the economy, while in trouble, maybe in need of some kind of stimulus. I think at this point, authorities are just a little bit too hesitant, or not. I mean, they're not too hesitant, but like they're just hesitant to do anything that would imply bringing on greater amounts of debt that they can't really afford, and so they're looking at targeted ways to try to continue to boost this confidence right now.
Jill, thank you so much. Jill Dices there with the very latest on the Chinese economy. Now, joining us now is Eric Nielsen, UniCredit's Group Chief Economist. Eric, thank you, first of all, for joining us. We're keeping you for half an hour so we can discuss everything from China to the U.S. to what's happening in the UK. How much worries do you have about China and the fact that we're expecting a lot more stimulus, but they're taking their sweet time?
I have worried about China for a long time. We both have these sort of big structural elements, the demographics and the handling of COVID and all these sort of things, and then we have the construction side. So we always thought they're going to slow down some, and I think these numbers they're not far off what people thought. And then we always have this idea that when China slows, they just sort of push the accelerator a little bit, and then everything goes again. This time they're a little bit more hesitant. I don't really know why. I don't know the policymakers there. But one thing is very clear: the way the Chinese accelerate or stimulate is through credits or other help for the big old industries, and that's not a good way of doing it. So I'm very worried about China sort of longer term or medium term for growth.
But at the same time, I keep on being told that actually President Xi needs to remanage this economy to add more value. So if they can go up the value chain by around 30%, but that would mean less money to the old industries.
Absolutely. I mean, there's no doubt about what they should do, what they would like to do. I'm just not confident that they are willing politically to do what it takes.
Eric, our reporters on the ground also spoke with Janet Yellen, who's of course at the G20, and she spoke about U.S.-China. Here she is.
The tariffs were put in place because we had concern with unfair trade practices on China's side, and our concerns with those practices remained. So perhaps over time this is an area where we could make progress, but I would say it's premature to use this as an area for de-escalation, at least at this time.
So, Eric, when you listen to that, and again, we're in an election cycle in the U.S., so how much more China bashing will we see, and does it translate into worse economics?
Yeah, I think it is, and I think there are two things here. The train has left the station in terms of free and low tariff trades between America and China, right? Then there is the present acceleration that we have seen because of all the noise around the two countries, and then, as you said, the election cycle in America. So you can't the next year and a half bet on America sort of giving China a sweet deal, right? And all this is bad for growth. Let's be very clear about it. It may be good for the long term of geopolitics or what have you. I mean, that's a kind of a different discussion. But as an economist, you look at what's happening now, it's not good for global trade, it's not good for global growth, period.
And we'll talk a bit more about supply chains moving and this de-risking. Eric Nielsen stays with us. He is, of course, from UniCredit. Coming up, Richemont shares slide this morning after investors focus in on declining revenue growth from the Americas. We dig deeper into the numbers next, and this is Bloomberg. What do you like most about your job?
I think the people. I mean, ultimately, we're a people business. A lot of what my job is as CEO of the company is to give those people sort of motivation, to tell them where we're going, to encourage them to come up and do their best work, to encourage them to collaborate. Sometimes you sort of think you're almost a psychologist, as you are a business leader, I think, sometimes.
And so what's your best piece of advice?
I love pitches. I love being sort of leading from the front, if you like, and spending times with teams. I love to see the work that we're doing. When we pitch for a piece of new business, often when we come together. So I guess I try and put myself in the seat of the client. And what's the client going to think when they see this work? Are they going to be excited? Is it going to turn their brand around? How's it going to resonate with their consumers? So as much as possible, I think probably I try and play that role.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
The conversations that matter, the insights you need. This is The Pulse, and I'm Francine Lacqua here in London. Now, Richemont shares lower this morning after reporting an unexpected decline in sales from the Americas. Now, it is raising concern over how weak the U.S. market might get. Follows fellow luxury brand Burberry, which also reported a drop in revenue in the region last week. Now, for more, we're joined by Deborah Aitkins from Bloomberg Intelligence. Deborah, thank you so much for joining us. So the U.S. decline, I mean, because this is ultra-high luxury, it doesn't necessarily go to the fact that actually the U.S. consumer is spending less.
No, and so the number that's come in is -2% for the Americas, so we don't have an actual US number. And what needs to be taken into context is that that's against a very high 20s comparable base, but we still do see some softening. It's the one region where there's a negative number.
Yes, so is it because we were also expecting too much? Because it seems like, they could actually price it to the hills, and how's Asia doing?
Yeah, and in terms of the US market in particular, we're looking at mid-single-digit growth, so we don't know what's under those numbers. Mid-single-digit by year-end, and there could be a fix because the comps become easier. And in terms of Asia, they've come in at +40, which is better than was expected. The market looked for 20. The market looked for 40, but is looking for 20 in Asia by end of year. So, and we've got a very easy comp coming through in their fiscal Q3. So I think one more than compensates the other.
Okay, really interesting, Deborah. Thank you so much. Deborah Aitken there from Bloomberg Intelligence. Now, still with us, Eric Nielsen, UniCredit's Group Chief Economist. And Eric, when you look at Richemont, look, there are signs that the luxury demand is weakening in the U.S. and possibly China, but luxury demand is not the normal consumer demand. So how's the U.S. doing?
I'm a bit worried. We have both in Europe but also in America, but America a little bit to a lesser extent, the following picture. We have very weak growth but a strong labor market. That's usually not the combination we have. And the reason why we have weak growth is that the commodity price increases we had have eroded people's income. In Europe, a lot. In America, somewhat less, but still a good deal. So people are tightening up, right? So the question you have to ask yourself when you look at these products and any other sector and the economy as a whole, is the next step that somehow we start growing again from here, and we had a mini recession or near recession with no unemployment?
No.
Or do people start to lay off, the companies start to lay off people and we get a more traditional recession? I'm more in the latter camp, but it's a tough one. We have never really seen this before.
But how much of this is the overhang of COVID, or how much is it's just structurally our economies have changed? I mean, even if you look at how inflation's coming down, maybe quicker than we thought, it's all quite strange.
Yeah, so there's definitely a lot of COVID aftermath going on now. And I think personally that's what confuses the central bankers. You know, I'm in the camp who think that the ECB and maybe the Fed have overdone it, because you see these inflation numbers. But what you see from COVID is that you're shifting back to the services now. So people you haven't traveled, you may have had your hair cut, but you haven't done your services or you've gone out. And now we are sort of plowing back, and there's a lot of overhang on that, but that's petering out. So we are going back to a more normal distribution of consumption between goods and services again. And that's disruptive, and it gives these strange inflation effects.
So do you think central banks should hold fire to see what happens next? You've always been on the camp that actually inflation was more transitory than central banks think.
Yeah, particularly in Europe. In America, there is, if I should round number, right? In America, it's probably 50-50 between demand and supply. In Europe, it's almost all supply. So the Fed has a better case of doing what they're doing. I would probably hold the fire here, but they'll probably do one more, right, or whatever. But it's like, but yeah, I think the risk is they overdo it.
Eric, what's your take on when you look at the dollar weakness? If this continues, I mean, this changes everything. It changes economies, it changes investments, it changes markets.
Yeah, I mean, look, it's first of all, we are not outside sort of historical ranges, right? So it's just that people always thought, oh, well, like the dollar has to be strong, and particularly when you go through a very tense geopolitical situation. We have the war in Russia and Ukraine. We have the China relations. So naturally, we went through a period where the dollar was strong. Now things eases a little bit. It sort of feels like you had Janet Yellen in Beijing after they didn't want to talk to each other for a long time. So this eases. So I think this is sort of the underlying story. That's good for Europe particularly because our energy gets cheaper, and so it's actually not a bad thing. But and I don't think it's going to get too worse, but I think it will still get a bit weaker.
Eric, thank you so much. Eric Nielsen from UniCredit stays with us, and we'll talk about the UK next. We look at the outlook for the UK as a new survey says business confidence remains strong and well above the European average. That's coming up shortly, and this is Bloomberg.
Race relations in the United States are much better than when you were growing up in Mississippi, or do you think we've made less progress than you think we should have made?
Both. I think that much better than when I was growing up. There's so many people who occupy areas and I never thought I would see them in. But I would have hoped it would be better. It's been a lot of progress. And somehow we're in an era now where, in spite of the progress, race relations in certain areas has become very scary. You know, some of the things that one reads about now remind me of growing up in Mississippi.
The top names in global leadership are on Bloomberg.
We have reformed the whole ecosystem around attracting foreign direct investment.
To get everybody to the table was the most difficult thing. Now we're here. The next is consummation.
The commitment is there. Now what we need to see is the actions.
Nobody covers the top global leaders like Bloomberg Television and Radio, your global business authority. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
So UK business confidence remains strong and well above the European average, according to a survey of 12,000 businesses by Accenture and S&P Global. The net balance of firms expecting activity to increase over the next 12 months stood at plus 40% in June compared to plus 19% across continental Europe. Now, this comes as a separate survey of economists paints a more gloomy picture, projecting that Britain's economic growth will fall further behind the euro area next year. Well, here to discuss all of this, Rachel Barton, Accenture's strategy lead for Europe, and still with us, Eric Nielsen, UniCredit's group chief economist. So thank you both for either joining us or staying with us. Rachel, what can you tell us about the survey? So I find a lot of these surveys quite confusing because periodically, every 6 weeks, there's also surveys in saying, look, inflation is higher than many countries around the world, interest rates are higher than many countries around the world, and so consumers and companies alike are worried.
So, as you said, Francine, and thank you very much for having me on the show today, in this latest report, UK companies are signalling robust levels of confidence. You gave some stats there about where we fall versus our European and global counterparts. And in this era of high inflation, many firms are under pressure. So the question for executives is how to transform and reinvent despite some of these macro challenges. And of course, this survey looks at a forward outlook. So I would feel encouraged that British firms are already taking action. We saw companies turn to growth, strong investments in artificial intelligence. They've almost doubled in the last year. And also for the first time since early 22, we're seeing an uptick in firms' intention to invest in research and development, as well as capital expenditure and employment.
So, Rachel, very quickly, when you look at the survey, do you know why they're optimistic? Are they optimistic because the job market is holding up and they're ready to spend? Or are they actually optimistic about the world economy?
Well, UK business has shown itself to be highly resilient in recent years, very adaptable despite some of these macroeconomic challenges. And although we've seen tremendous highs and lows across the world, the UK has consistently exhibited around twice the confidence levels of the rest of Europe. When I talk with business leaders, I'm seeing them refresh their strategies, really looking at technology as a way of creating bolder ambitions for the future. In private equity, you know, we're seeing huge investments in artificial intelligence, generative AI, in order to be much more targeted on assets for value. Consumer goods, we're seeing big investments in resilient supply chains. So I think that adaptability that we've observed from the UK is really where we are seeing those green shoots of confidence come from.
So, Eric, what's your take on the UK economy? If you look at, you know, we have the latest survey also of economists by Bloomberg saying that GDP will probably grow some 0.6% in 2024. Euro area, it should grow by 1%.
Yeah, I'm still worried about the UK. I mean, I haven't seen the survey. I haven't seen the survey we talked about, but you can certainly. There are a lot of great businesses in the UK. One thing that strikes me is that if you look at the PMIs, both for UK and Europe, there's a very big division between those in the service sector and those in manufacturing. And services are more optimistic than manufacturing. And maybe this reflects a little bit the fact that in the UK we have a little bit more service companies which invest, as she said, in technology and these things. So, but the UK is facing massive problems. The Brexit is not done yet. We have a fundamental issue. This is sort of my key concern about the UK that we don't talk enough about. It seems to me that the UK population wants, broadly speaking, the same services, public services, as the rest of Europe in terms of defense and healthcare and pension, all these sort of things. Yet,
how do you fund it?
How do you fund it? And so far, over the last 10, 20 years, the UK taxes the economy by 7, 8, 9 percentage points of GDP less than Germany and France, Netherlands, and even more than Italy. So how do you square the circle, right? Yeah. There is absolutely, Martin Wolf at the FT had a great piece last week, I think. There is no way that you can square the circle without putting taxes up a lot. And so much so that I wonder politically how you do it, right?
But Eric, is there also something in terms of population growth, or that there's the labor market is just odd because they don't have enough people. So no matter how much of a recession almost, it's going to be fully employed.
Yes, that's exactly right. So this comes back to what we talked about before, where we have a fundamentally strange situation with weak growth and a tight labor market. Yeah. But all of Europe, and including the UK, and maybe particularly the UK, has this problem that we don't like immigration anymore. The one reason why the UK could square my circle about tax revenues versus demand for so many years was they imported all these doctors and nurses from abroad, and the real income in these sectors declined and declined and declined. Now we don't want them anymore. So how in the world do we do it? Continental Europe suffer the same type of problems with demographics, if to a little bit lesser extent, but it is the sort of medium, longer term, a massive issue that Europe has to figure out how we deal with.
And Rachel, if you have a breakdown, is manufacturing, doing better than some of the under industries? Like, what's the breakdown of who is feeling more confident out there?
Sure. So if we look at manufacturing and services, we saw a slight decline in the services confidence. In fact, manufacturing in the UK fell by about 10 points. It's still more confident than manufacturing colleagues across Europe, but we absolutely saw the challenge, particularly in chemicals, timber, metals, around high costs. Maybe companies are still getting through the stockpiles that they accumulated during COVID. And to the point around wages, absolutely saw that the 3/4, in fact, of UK companies surveyed did think that wages would need to go up, largely due to the cost of living crisis and the labour shortages that were just referred to there.
Rachel, thank you so much. Rachel Barton, they're Accenture's strategy lead for Europe, and Eric Nielsen, UniCredit's group chief economist. Coming up after JP Morgan and Citi's results on Friday, we'll look ahead to more big bank earnings this week. We'll discuss what to watch out for next. And this is Bloomberg.
We can replicate Tesla. Tesla is a unique because when they founded and then the personality behind it, the product is beautiful, technologically very, very strong. So in many areas, Tesla is Tesla, but Xpeng is Xpeng. We want to focus on what we think is important for our customers. Our customer like beautifully designed vehicles, either it's large SUV or sports sedan. We believe we have a very, very appealing family look that our customers is really attracted to. They like to have user-friendly features inside the cabin that has a technology feel. It's very smart. It enables them to really utilize the vehicle that's different.
Three prime ministers, 4 chancellors, an energy crisis, and the soaring cost of living. It's been a hard year for startups, but even in the toughest times, some of the best ideas are born here in the UK. Bloomberg UK's Startups to Watch will profile the brightest companies under 10 years old, with the winners unveiled at the Bloomberg Technology Summit in London in October. Get your entry in by the 7th of August for the chance to have your company profiled and to attend unique networking events. Good luck, and we hope to see you there.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, China Open.
This is Bloomberg Technology.
Welcome to Balance of Power. This is Bloomberg.
Now, China's second quarter growth disappoints amid poor retail sales and the latest sign of the nation's struggling recovery, prompting more stimulus calls. U.S. Treasury Secretary Janet Yellen calls for further de-escalation of tensions with Beijing, but says it's premature to discuss trade. She joins us exclusively later from the G20. Plus, Richemont shares slide after the Cartier owner reports an unexpected decline in sales from the Americas, but demand in Asia rebounds. Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. So Wells Fargo earned more net interest income than analysts expected in the second quarter. The San Francisco-based bank has also lifted its guidance for the full year as big U.S. banks continue to benefit from rising U.S. interest rates. The CFO, Michael Santomassimo, spoke to Bloomberg on the back of the results.
We're relatively small, compared to some of the, the big peers out there. But it's something that we've been focusing on now for the last few years, and just really making sure that we're consistently adding the right people. We're investing in technology, and really the focus is to just support our clients better. It's focused on the U.S.-based clients for the most part. There's some outside the U.S., but really primarily here in the U.S., and it's just supporting our corporate clients and our asset management clients and others just better and better each day incrementally. And so we're happy with the performance we had this quarter and last quarter, and I think that shows through the fees. But it's something that we'll just keep gradually building on over time.
Mike, let's talk about commercial real estate because it caught a lot of eyes that actually Wells Fargo increased the allowance for credit losses by about $950 million, and it was commercial real estate office loans that were cited for the reason behind the move. So as I understand it, you haven't seen significant losses yet, but you had CEO Charlie Scharf say that you expect to see it play out in that market over time. When are you anticipating to see peak pain for commercial real estate?
Well, I think I would just broaden it a little bit first, then I'll come back to office. And when you look at the overall credit picture, it's quite good. On the consumer side, we're seeing a little bit higher charge-offs, but that's off historic lows. And so, that's actually performing quite well so far. And broadly on the commercial side of the business, it's going quite well in terms of both the our middle market and commercial banking clients, and big chunks of the commercial real estate portfolio are actually performing really well so far, particularly given where we are in the cycle. And so really this conversation is focused and isolated on the office portfolio. And I think as you look at office, it's a lot of the trends that we all are talking about now for a while in terms of return to office, companies needing less real estate, and that's starting to come through in different cities and different properties across the country. And what we did today, or in the quarter, is make sure as we sort of look at all the things that we can see and then think about a whole bunch of different scenarios, that we stress in the portfolio, and so we built a reserve that we think is appropriate to deal with a number of those scenarios. But keep in mind, we haven't, as you said, we haven't really seen the losses be significant so far. But there will be some weakness over time, and it will play out over an extended period of time, and likely years, not months or quarters, as people work through the changing patterns and different issues with individual properties.
Wells Fargo CFO there speaking to Bloomberg's Romain Bostic and Katie Greifeld there. Now, JP Morgan revenues soared to a record $41.3 billion in the second quarter, boosted by high rates and its takeover of First Republic Bank. Quarterly net interest income rose to an all-time high, with the bank also hiking its full-year NII forecast to $87 billion. Now, the Chief Executive Officer, Jamie Dimon, says the U.S. economy continues to be resilient, but he did caution on the outlook and recessionary risks.
The headwinds are substantial and somewhat unprecedented. This war in Ukraine, oil, gas, quantitative tightening, unprecedented fiscal needs of governments, QT, which we've never experienced before. And I just think people should take a deep breath in that. And we don't know what those things could put us in a soft landing, a mild recession, or a hard recession. And obviously we should all hope for the best.
So here with more, Bloomberg's Leonard Kenscherper. So Leonard, now that the dust has settled, how good were these JP Morgan results?
Yes, I think you could already see from the reaction of the shares on Friday that they didn't react too heavily. So a lot of expectations might have been baked in already. And as Jamie Dimon said, there are some unprecedented headwinds, and it's not just potential pain from consumers, not just potential credit card delinquencies. It's also the Fed's quantitative tightening, which will in the coming quarters drive up banks' funding costs. So I think it's fair to say that bank profits won't keep on surging from here.
Any red flags?
Yes, I think one area of concern is commercial real estate, especially for old offices. And another big cloud that generally hangs over U.S. banks at the moment are the potential higher capital requirements that the Fed is expected to impose at some point. Jamie Dimon, I think, also said basically hedge funds, private credit, they're dancing in the street right now because they're expected to gain more market share from lenders here, and it also shows you how worried lenders are. They're losing market share to non-banks here.
Leo, when you look at, of course, some of the other bank earnings, it's a huge week. What are you looking for? Not every bank is created equal in the U.S.
That's true. So I think Goldman Sachs is the most interesting one to report. They're due to report on Wednesday, and they've been quite proactive in flagging how bad trading went in the past weeks. So they said investment banking slowed down, trading momentum slowed down 25%. They flagged write-offs in their real estate book. And they did all this because their shares dropped in the past 2 quarters on earnings day. So they really want to avoid disappointing investors again on earnings day, and we'll see how that plays out on Wednesday.
All right, Leo, thank you so much for joining us. Of course, Leonard Kenscherper there on the very latest on some of these banks. Now, Nordea Bank also reporting better than expected profits in the second quarter, supported by tailwinds from rising interest rates. Now, the biggest lender in the Nordic region raised its full-year profitability guidance as net interest income rose 40%. So joining us now for more on this is Bloomberg's Chris Ljungstedt in Stockholm. Chris, good morning. So what are the main takeaways from Nordea this morning?
Good morning. Well, Nordea posted better than expected figures overall. What can be said is that their return on equity guidance for the full year had been criticized by analysts prior to the report. However, their boost of that guidance to comfortably better than 15% has not been that well received by the market so far, with shares just slightly up today. Net interest income, however, was 40%.
Yeah, sorry, go ahead. Net interest income, 40%.
Yeah, net interest income was 40% higher than last year, and that was in line with expectations. Analysts do, however, expect this to be the peak in terms of NII growth.
So other Nordic lenders reporting this week, will they all be similar in terms of what they're reporting or what you're looking out for?
Well, the NII is, of course, always important, and perhaps even more so in this new climate. After the Riksbank's rapid rate hikes, it's a new ball game for private consumers, for corporate customers, and for the banks themselves. Mortgage margins are highly under pressure, and customers are shifting deposits to more expensive savings accounts. So analysts expect NII to drop going forward, so any signals or hints in that respect will be highly interesting, of course.
So what are the impacts of commercial real estate turbulence on the Nordic banks?
Yeah, that's a big thing this week, of course, and this story will go on for a good while. There seems to be different views on it, however, though. Moody's recently cut the outlook for Handelsbanken's credit rating to negative, citing concerns for these exposures to the commercial real estate sector. The Swedish FSA head, however, recently, just the other day, said that the worry about these exposures is perhaps a bigger thing among foreign investors than among Swedish investors, and added that he is not concerned. What can be said is that investors seem to be more critical. All the Nordic banks, except for Danske Bank, have been lagging European peers so far this year, and that is in part because of these worries.
All right, Chris, thanks so much. Chris Ljungstedt there in Stockholm for us. Now, also a trio of French businessmen led by telecoms billionaire Xavier Niel have pulled out of the race for the troubled retailer Casino. The withdrawal by the investors after months of work leaves the way clear for Czech investor Daniel Kretinsky to take control of the French supermarket group, which has been struggling with debt for several years. Coming up, the G20 meeting for finance ministers and central bankers has kicked off today. Key themes, of course, inflation, energy, and EM debt. We're live in India with all of the latest. That's next, and this is Bloomberg.
The deal was the brainchild of Apollo CEO Mark Rowan. In January, Apollo closed its $11 billion all-stock merger with Athene Holding. It had already owned 35% of the insurer. Here's what Apollo gets out of the deal. Assets under management. Apollo expects them to double to about $1 trillion by 2026. Much of that projected growth will come from the merger, and those assets are especially attractive to Apollo. Insurance companies typically go after much more modest returns than buyout investors. That will give Apollo more options for investing the cash. Athene is a steady provider of fee income. It has grown into one of the nation's biggest holders of fixed annuities, those retirement savings products favored by risk-averse customers. The merger will also allow Apollo to simplify its governance. It gave up its dual-class share structure and adopted a one-share, one-vote plan. The hope is that will eventually lead to Apollo's inclusion in the S&P 500.
Season is here.
You're going to see cracks start to emerge. This earnings season could be a little bit choppy.
This is going to be an earnings season mystery. Bloomberg breaks the numbers first.
Those earnings just crossing the wire.
Up by 25%.
Absolutely blew out of the water expectations.
With exclusive expert analysis.
We're starting to see earnings recovery emerge.
AI will be a huge boost of revenue growth.
You're not going to see the same follow-through in terms of the price reaction.
Second quarter will be where the rubber meets the road.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
Our expectation is that the headline inflation will decline slowly, not with the speed of headline inflation. Core inflation will be slower. So this is, I think, because of the fact that headline inflation is influenced by energy prices, and the core inflation is influenced by the increased prices, wages, services. So a mixed situation, but overall, I think we will have in 2024 the level of inflation near to our targets.
So inflation has peaked, underlying inflation has peaked for Europe.
For sure.
Is stagflation the right word to use to describe the European economy right now?
Well, listen, we still have growth, weak growth, of course, slightly weaker than expected in the first quarter and probably also in the second quarter. But if we look to the last autumn, we were expecting a real recession, blackouts, energy problems, supply problems for energy. These risks didn't materialize. I'm not saying that we don't have any risks ahead of us, because indeed tightening of monetary policy will produce impact, and also the energy transition. We are not completely out of the woods in Europe. We made a miracle in going out of the dependency from Russian fossil fuels, but it will be a challenge also for next winter. Overall, I would say we are not in a stagflation situation. We still have growth, and we expect in 2024 to have stronger growth. And we have an incredibly resilient labor market.
Well, that was the EU Commissioner for the Economy, Paolo Gentiloni, is speaking to our Haslinda Amin from the G20 meeting of finance ministers and central bank governors in India about the outlook for inflation in the euro area. So let's talk more about the G20 meeting, where some key items on the agenda include inflation, debt relief, and sustainable finance. For more on all of this, we're joined by Bloomberg's Manaka Doshi. Manaka, good afternoon to you. What's actually coming out of the meetings today?
Well, three key issues under focus here, Francine. The first is the reform of multilateral development institutions or banks, how they can raise or enhance their finance capacity, especially through private capital. The second, more relief for debt-burdened low-income countries, and whether the Zambia debt resolution is a precedent-setting one for many other countries that are waiting in line for the same kind of solution. And third, whether this meeting is going to end in a communique with a resolution on the use of the word war, or is this also going to be a chairman's summary of sorts? And these three are the key talking points here in the conference in Gandhinagar.
So, Manaka, we're also hearing of a renewed focus on India and economic growth there.
Well, that's right. I think, Francine, as you know, our G20 meetings are, of course, multilateral conversations, but also an opportunity to do bilateral talking. Here we've had the Indian finance minister, who's playing host to this meeting, speak with finance ministers from across the world to talk about the India story, friendshoring, China +1. And that's a conversation she had with the Indonesian finance minister as well, who spoke to Bloomberg, underscoring the relationship between the two countries and how India is now providing an alternate route to China.
China is not recovering as what we originally thought after opening from the COVID. So Indonesia is now looking at other alternatives like India. Here we are here is actually growing in terms of the market.
And that's exactly what U.S. Treasury Secretary Janet Yellen also emphasized earlier in the morning here today after her bilateral conversation with the Indian finance minister. She underscored the relationship with India, emphasizing the close friendship, and also talking about how India represents a great friend-shoring opportunity. Don't forget, this is Janet Yellen's third trip in a year here to India.
Thank you so much, Bloomberg's Manaka Doshi there in India for us at the G20. Now, coming up a little bit later, this is an interview you don't want to miss. We'll be speaking to the U.S. Treasury Secretary, Janet Yellen. Catch that exclusive interview right here on Bloomberg TV. It's at 1:10 p.m. UK time. Coming up, the dollar. Bloomberg Spot Index was down some 2% last week, the most since November. We'll discuss the outlook for the world's most important currency next. This is Bloomberg. What do you like most about your job?
I think the people. I mean, ultimately, we're a people business. A lot of what my job is as CEO of the company is to give those people sort of motivation, to tell them where we're going, to encourage them to come up and do their best work, to encourage them to collaborate. Sometimes you sort of think you're almost a psychologist, as you are a business leader, I think, sometimes.
And so what's your best piece of advice?
I love pitches. I love being sort of leading from the front, if you like, and spending times with teams. I love to see the work that we're doing. When we pitch for a piece of new business, often when we come together. So I guess I try and put myself in the seat of the client. What's the client going to think when they see this work? Are they going to be excited? Is it going to turn their brand around? How's it going to resonate with their consumers? So as much as possible, I think probably I try and play that role.
Our studios in New York and San Francisco, our expert hosts of the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television, your global business authority.
The conversations that matter, the insights you need. This is A Pulse. I'm Francine Lacqua here in London. Now, we're just getting some breaking news out of Morgan Stanley. They're updating their GDP forecast. Now, Morgan Stanley cutting its 2023 China GDP forecast to 5%. Earlier, they were expecting a 5.7% increase, and it's a similar move from Citigroup. So they're now expecting China 2023 GDP to be 5% instead of the 5.5% that they were earlier expecting. Now on to the dollar, seeing its worst slump since November last week as traders see the Fed's historic rate hike cycle cooling or stopping soon. The world's primary reserve currency is now teetering at the lowest level in more than a year. Now for more, let's go straight to our Bloomberg MLive currency and rate strategist. He's Ven Ram. Ven, always good to have you on TV, so thanks so much for coming on. The bears are out for the dollar. What's your take?
Morning, Francine. Thank you for the kind words. Well, there are broadly two ways the U.S. economy could evolve from here. One is that inflation slows to an extent that the Fed becomes convinced that it will meet its inflation target and they back off from further hikes. Or it could be that the labor market completely crumbles. In either scenario, the dollar will continue to weaken and the euro will go to $1.14, the pound to 1.35. Those are pretty much consistent, Francine, you will remember, with levels that MLive forecast at the start of the year. If we stay in a world where inflation isn't the 8% we saw last year, but still middling in the 3 to 4% range, the Fed will not cut rates, but even in that scenario, the dollar will tread water. So pretty much, it is a dollar bearish scenario. There's no question about it.
But Ven, what does this mean? I mean, this changes everything, right? It changes traders, it changes markets, it changes deficits. Like, is there a critical lever for where, you know, some countries could be in trouble if dollar goes below that?
Well, I think on the DXY, if the dollar goes below 95, we could hear a lot of chorus from other central banks, and we would see this competitive devaluation starting. But at the moment, because pretty much all the non-dollar currencies were battered last year, they're not quite back to levels where, say, the ECB would start pushing back on strength in the euro, where the BOE would start pushing back on the strength in the pound. We are not at those levels yet, but as you say, if the dollar index weakens to 95, we could be there.
Ven, what's your take on China right now? So I don't know whether you play it through renminbi if we do have more concerns about the economy, unemployment, especially for the youth at a record high, with policymakers not doing as much as markets are expecting them to.
Absolutely. I think the most direct way to play it is through the offshore yuan. Now, there are several points that jump out from the disturbing Chinese data that we got this morning. One was that growth in the second quarter was supposed to have topped 7%, given that Shanghai was in lockdown at this point at the second quarter last year. So while 6.3 may look pretty impressive prima facie, it really isn't. And we got a dichotomy between factory output that did pretty well, but retail sales were nowhere near as good. So it shows that the Chinese consumer is not willing to really spend. So where is China going to find that growth? It's going to find its growth from relying on its age-old model, which is reliant on exports. And in order to rev up exports have been in a funk too this year. And in order to rev up exports, you need a much weaker yuan. If you look at the yuan this year, it hasn't weakened that much at all, 3% or thereabouts. And China needs a much weaker yuan to get to that 5% growth rate this year.
Yeah. So, Ven, overall, I mean, given all of this context, I don't know whether, you know, rates are juicier than currencies. Do you look at treasuries maybe, or is the dollar really the dominant one?
I would definitely be inclined to look at long duration treasuries. I just wrote last week that, look, I mean, if you're in the hunt for duration, now is the time to be doing it, because the US economic cycle is aging and there are visible cracks in the economic momentum. So I do think that, you know, now is the time to lock in the duration trade. Now is the time to be buying the 10-year treasuries. Now is the time to be going in deep on 30-year treasuries, because you're unlikely to get those yields for too much longer from here.
Ven, thank you so much, as always, for joining us. Ven Ramler, Bloomberg MLive currency and rates strategist. Now let's take a look at what we're watching out for the rest of the week. Today, G20 finance ministers and central bank governors meet in India to discuss economic trends, energy security, and support for developing countries. Tomorrow, more U.S. banks report earnings, including Morgan Stanley, BNY Mellon, and Bank of America. Then on Wednesday, UK CPI data comes out. It's expected to further demonstrate the persistence of UK inflation. On Thursday, we'll get the latest interest rate decision from the Turkish central bank, which is predicted to continue its aggressive monetary tightening campaign. We'll also be keeping an eye on U.S. initial jobless claims data. And finally, on Friday, Japanese CPI data due to be released. It's expected to confirm that inflation in the country has reached its peak. Well, that's it for the Pulse. Up next, Bloomberg Surveillance Early Edition. They'll go through most of the market moves. This is Bloomberg.
half of all American women in opposite-sex relationships now make the same or more than their husband. That's a record high. According to a new report by the Pew Research Center, a third of U.S. women are in egalitarian marriages, making roughly the same as their husbands, and another 15% of them are the breadwinners. Women with college degrees and no children, as well as Black women, are even more likely to make more or the same as their partners. But not everything is a bed of roses. Working wives still carry most of the weight of unpaid labor. Women in egalitarian marriages spend almost twice as much time taking care of the home or a loved one, while dedicating less time to leisure.
Women are continuing to go out in the formal labor market and contribute and are still bearing all of the load of responsibility that disproportionately falls on them in terms of family care.
During the pandemic, in the wake of school shutdowns, the height of the childcare crisis pushed nearly half of American women out of the labor force, a trend that's yet to be reversed.
Women are just really struggling to meet the care needs of their family, and at the same time are really, really leaning into the labor market. And I don't think we've seen this before in history, to be honest.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
This is Bloomberg.
This is Bloomberg Surveillance Early Edition with Danny Berger and Kriti Gupta.
It's 10 a.m. in London, 5 a.m. in New York, 5 p.m. in Hong Kong. Our top stories today. China's economy lost momentum in the second quarter, missing estimates and ringing new alarm bells about its recovery. U.S. Treasury Secretary Janet Yellen says she's eager to build on recent improvements in U.S.-China relations as finance chiefs from around the world gather in India. Yellen speaks exclusively with Bloomberg at 8:15 a.m. New York time. And the end of an era? The dollar's recent drop has a bevy of strategists and investors saying a turning point is finally at hand for the world's reserve currency. Good morning and welcome to Bloomberg Surveillance. This is the early edition. I'm Danny Berger in London. Kriti Gupta is in New York. Kriti, we survived the China data dump in the wee hours of this morning. Now we just get a little bit of a break before a whole lot of earnings our way.
Yeah, we absolutely do. And I think it's really affecting perhaps the way that futures are trading stateside, even though I would say they're not major conviction either direction, but you are seeing some interesting action in futures right now, Danny. I like to look at NASDAQ 100 futures because, ironically, that's where you're seeing the most action. It's only higher by 0.1%. If you look at S&P futures or even Russell futures, you would start to see that they are essentially flat or down by a very, very tiny margin, which tells you that perhaps the tech story is already getting a little bit of a lead start coming out of the China trading session, of course, the European trading session as well. What's interesting to me, though, is the bond market, because, again, a continuation of last week's narrative when it comes to bond market volatility, that two-year yield at 4.72, retreating even further, 4 basis points lower. Now, a few folks in the market, I wouldn't call it consensus yet, but a few folks in the market saying that perhaps those rate cuts that are priced in may actually materialize, maybe not this year, but as early as March of 2024. And that is a big deal for Wall Street to kind of get on board with what the market is pricing in. Of course, as we look at the dollar, the bond move, we have to look at the dollar as well. Dollar yuan really in focus today, coming off of that China data, as you point out, Danny. We're going to get into the details in a moment, but big picture, what you need to know is dollar strength against the offshore yuan. 7.17 on that currency pair, stronger by about 0.2%. But again, sticking with the China story, if the question is about growth and whether or not China is going to be exporting deflation, commodities are a great gauge of that. Copper, we're going to use as our kind of bellwether. They're down almost 3% on the session, which really tells you that you're seeing some pain in the commodity space off the China story.
Well, the dollar might be stronger this morning against the yuan, but it still is a stronger euro story. That's the word so far here in the European trade. We're stronger by about 0.1%, the euro versus the dollar. Good news for perhaps tourists who are going overseas, which has really helped support, bad news rather, for tourists going overseas, which has helped support the European economy to some degree. And we're starting to see signs of what it means for the American consumer to not participate in European companies. I really want to highlight this morning what's dragging Europe down. It's the China data, and it is also Richemont earnings. Richemont falling some 8.5% after having earnings this morning. They released them, and it was about in line with what analysts expected. But the really sour point was America revenue. It was expected to gain some 5%. It actually dropped 2%. The rest of the world was okay. Europe was good. You had, again, consumers traveling from China and from the U.S. to Europe to buy Richemont goods. Even Asia sales were okay, but that combined with the ugly China data means it's a really bad session for luxury. You can see LVMH also dropping nearly 4%. So, Critty, you got to get out there. You got to buy some Van Cleef. You got to buy some Cartier. They're clearly in need of it.
Yeah, I'm sure my piggy bank is really going to help them out when I start to invest. But again, you pointed out it's really all about the exposure that they're getting in the U.S., but also in China as well. And that's kind of where I want to go. Over in Asia, China's economy expanded more slowly than expected in the second quarter. GDP grew 6.3% from a year prior against the 7.1% forecast. Joining us now, Bloomberg China economy and government editor Jill Deesis. Jill, the call for stimulus, how big is it growing given in the backdrop of the likes of Morgan Stanley, Citigroup this morning actually cutting their forecasts on that Chinese growth?
Yes, exactly. Well, I think that, so first of all, while there might be some investor calls for more stimulus, I don't really think that the Chinese government or a lot of economists that are watching this economy see it that way. Ultimately, it does seem like stimulus of any sort is going to be limited. It's going to be targeted. That's the message that we've been getting from this economy for quite some time now. We just saw from the central bank last week that it's likely that, even if there's more additions for the property market, for example, that would probably be pretty targeted and limited in scale. And that was just before we just saw this data earlier today that showed property investment contracted in the first 6 months of the year by even more than what economists were expecting. It's a really difficult, I guess kind of, way to see this when you're thinking, oh, well, maybe, you'd want more stimulus to try to help the economy. What the government's looking at is, are they taking on more debt risks by doing so? Is there really a lot that monetary policy can do to move the needle, especially when the Fed is expected to hike later this month and you still have some of that aggressive hiking going on elsewhere in the world? Ultimately, yes, it's a very challenging picture for the economy, but it all kind of boils down to still this idea with some of these downgrades that you're seeing from economists of, well, as long as they're still within this target that they've set earlier this year of about 5% growth, which at this point it does seem like China is, maybe there's still not that need for anything that seems more aggressive than just those targeted policies that are hopefully going to help, boost confidence. But at this point, confidence is still pretty low, so we'll have to see how that goes.
Yeah, Morgan Stanley and Citigroup cutting their 2023 GDP to 5%. So as you say, still within that target. Jill, thank you so much. That's Bloomberg's Jill Deesis. Now, Treasury Secretary Janet Yellen says the U.S. should look for ways to further de-escalate tensions with China, but added it would be premature to eliminate the tariffs imposed on it by the Trump administration. Yellen was speaking to reporters ahead of the G20 gathering in India this week.
Perhaps over time, this is an area where we could make progress, but I would say it's premature to use this as an area for de-escalation, at least at this time.
Joining us on the ground at the G20 summit is Bloomberg's Menka Doshi. Menka, what's coming out of the meetings today?
Well, I'd like to point out to you, Danny, that this is Janet Yellen's third visit to India. And amongst the many comments that she made, one of which you played, she also emphasized the need for multilateral development banks across the world to shore up their financing capacity. And that is one critical talking point here at G20 through the course of the year. And in this meeting as well, we have the World Bank President Ajay Banga here, along with the heads of many other MDBs. And the question is, are they going to be able to step up their financing capacity, and are they going to be able to crowd in private sector financing? The second big issue here is relief to debt-burdened, low-income countries, and whether those on the edge of default or who have defaulted already are likely to benefit from the kind of resolution that Zambia has seen, the details of which we don't have fully, but we do know that it took a long negotiation to get China onto that agreement table. So these are the two core issues that are being discussed here at the G20 in Gandhinagar in Gujarat in India, amongst the many other issues, including concern about the economic recovery in China and what's going on with interest rates across the world.
Yeah, a lot to digest and a clear read-through coming out of Asia. Bloomberg's Menaka Doshi coming up, joining us from New Delhi. We thank you as always. Coming up later from the G20, we'll of course be speaking to the U.S. Treasury Secretary Janet Yellen. You can catch that exclusive interview right here on Bloomberg Television at 8:15 a.m. New York time. Now we are getting some breaking news. Russia saying that the Ukraine grain deal has expired today, that coming from TASS. What's important to keep in mind is that you are having a real read through into the commodity space. You are starting to see wheat futures and soybean futures spike on the news. We know that Vladimir Putin on Saturday said that the demands over the deal hadn't been met. It was a deal that was brokered by Turkish President Erdogan and really allowed some of the grain to exit Ukraine and really get shielded from some of the attacks on the ports there. Certainly something we're going to be monitoring. In the meantime, you have U.S. and China relations under pressure as well. China, on the other hand, intensifying military drills with Russia. That comes as Russia blames Ukraine for damages to its flagship bridge to Crimea, killing 2 people and causing the suspension of road and rail traffic. Joining us for more is Ross Matheson, Bloomberg's news director for Europe, Middle East, and Asia. Ross, walk us through all of these developments in Russia. How big of a deal is this when it comes to both the bridge and the grain deal?
Well, it's interesting because this grain deal has largely been dead anyway for some weeks. There's been very little movement of Ukrainian grain out through past Turkey into the rest of the world anyway. So it's been really troubled for some time. But now we have Russia officially saying they're refusing to extend this deal further past the deadline of today, although they say under some circumstance in the future they might come back to it. It comes, of course, as we've seen another explosion today on that key bridge, which links Crimea, which is occupied by Russia, with Russia itself. And that's a really important bridge for Russian President Vladimir Putin. Crimea really is a red line for him. And whether he needed a pretext to nix this deal is a question, really. But he's saying that Ukraine, of course, carried out some sort of attack on the bridge today, a drone attack. So an effort there by Russia to at least link those events. What we do know, of course, is that the grain deal, as I said, has been on a slow ball for some weeks already. The question is, at what point in the future would Russia be willing to come back to it?
Roz, could you also put into context the news we learned over the weekend about Russia temporarily, at least they say, seizing the Russian subsidiaries of Danone and Carlsberg? Is this something Russia has done before, and what does it mean for these corporations?
Well, that's right. They have done it twice before with 2 other companies, but it's the first move in a while. And of course, Russia says this is a temporary move, but it's hard to see, having seized these assets, they'd be willing to give them back. And it really reflects the difficulties that many of these Western companies find themselves in. Some have managed to pull out of Russia entirely. Some have found it very difficult to do so, to divest their assets or to reduce their footprint there. And really sort of now we're seeing the difficulties that are coming as a result of that. But equally at the same time, investors in these companies have probably largely written down those assets since the war began, since Russia invaded Ukraine in February last year, and it's sort of priced in some risk there as a result. So you're not going to see significant moves in the shares, for example, today. But again, it just shows that balancing act for those companies. Do they stay entirely in Russia? Can they reduce their footprint there? If so, how? How can they divest their assets in a way that is acceptable to their shareholders? So really just highlighting again the complexity and probably a warning to some other Western companies still operating there, Nestle, Coca-Cola, and so on, that they might be next to be targeted.
Yeah, and I'm also just checking out oil's price. That also spiked on that wheat headline too. Just really shows how supply chains are still under pressure from the ongoing war. Rosalind, thank you so much. Rosalind Matheson, Bloomberg News Director for EMEA. So that's a story in Russia. Let's talk tech now. And Microsoft will keep Call of Duty on Sony's PlayStation to ease antitrust concerns about its $69 billion acquisition of Activision for the latest on the saga. We're joined by Bloomberg Quick Take's Alex Webb. Alex, they seem just so close at this point. What are the final hurdles that remain?
They really need a green light from the UK. It seems they've cleared everything in the US. There was a final effort from the FTC at the Court of Appeals to sort of put a stay on the deal, stop them from closing it. They failed on that front. They're now trying to get it through the UK. There is a hearing today, Bloomberg is reporting. The target is for it to close tomorrow. So the UK is really up against it. The UK regulator, the CMA, if it wants to stop that deal, they have sort of issued a kind of stay of execution in a sense by giving them scope maybe to make some more concessions. It seems as though the concessions are going to be the way that Call of Duty in particular is sold for online gaming in the UK, for cloud gaming. That's been the bone of contention here in the UK, slightly different from the US, where they were looking more broadly at the role that it played in the gaming space. But, you know, as in football, they would say when you get close to the final whistle, it's squeaky bum time.
They need to defeat the final boss, Alex.
Exactly.
Alex, what's interesting to me, though, is that they did broker that deal ultimately with Sony. For the U.S. perspective, a lot of the FTC testimony really was kind of based on what Sony was claiming in terms of kind of exclusivity in the console market. Alex, talk to us about the UK regulatory process here. We know we have that hearing coming up today, but the timeline for the CMA has extended to August 29th. What happens between now and then?
Well, yeah, so what we saw happen in the US was that, firstly, the process is a little bit different because it's almost as though the FTC operates as an equal-footed entity. It kind of can sue to block the deal. It doesn't actually have the power just to unilaterally stop a deal. That is not the case in the UK. They stop a deal and then the companies involved will appeal it. That is what is happening now. In the US, they focused on control of the gaming market as a whole, role in the gaming market as a whole. Microsoft and Activision made the case that actually the deal wouldn't make much sense if they weren't selling, in particular, Call of Duty. That's their big blockbuster, so-called AAA game on the PlayStation. The economics just don't add up. In the UK, it's really about cloud gaming. Now, it looks as though they might find some sort of agreement which will let the deal still complete tomorrow. Worst case scenario is that the whole process has to start again. It's unclear then how that would all pan out, given that the deal might well close. One caveat to all this, Facebook's acquisition of Giphy, the GIF, Meta's acquisition of Giphy, the GIF website or app, that closed, and then the UK blocked it after the fact. Facebook did end up selling Giphy. So there is a path. Microsoft Activision, though, a lot bigger deal, a lot more complicated.
Alex, thank you very much. That is Bloomberg Quick Take's Alex Webb. Now, coming up on the show, the U.S. dollar snaps a 5-day losing streak after its worst run since November. We'll have more on that trend next. And Fed speak goes dark ahead of the rate decision next week. We're going to be catching up with Simon French, chief economist at Panmure Gordon, later this hour. Plus, U.S. bank earnings in full swing. We'll get a deeper look with Bloomberg Intelligence in our roundtable. This is Bloomberg.
What's the best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes, yes. Not keeping, look, people have conviction, or they invest for if they invest for the right reasons, just keep at it.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta in New York with Danny Berger in London. Look, the trade today seems to be all about the economic data we got out of China. The idea that growth may be slowing down way faster than expected, something that now Citi and Morgan Stanley are saying is going to have a real read-through into their GDP. For our radio audience, stick with me. For our TV audience, we are looking at their median 2023 growth estimates, of course, coming from those private economists. You are now seeing it being cut to 5% for 2023 from the previous of 5.5%. That is a massive deal when you look at the FX trade and the bond trade just as early as 5 a.m. this morning. I want to kind of see how that translates into the bid for the dollar. Joining us now, a true expert on the FX space, Bloomberg Markets Live currency and rate strategist Ven Ram joins us. Ven, when we talk about China potentially exporting deflation to the rest of the world, how does that have a read-through into, say, that dollar weakness?
Morning, Kriti. Obviously, China's exports haven't gained traction at all this year. And what we saw from the data this morning is that, look, I mean, they need to be doing a lot more stimulus to revive the economy because, you know, what we have seen is that the property sector is in doldrums, and that's 1/3 of the economy. And so they have to, if they're going to get the 5% growth that you just mentioned, they need to revive exports, which accounts for 1/5 of their economy. And if they do that, that's not going to have massive implications on the dollar, I'm afraid, because, you know, China, as you said, is exporting deflation into these economies, but we are in the late economic cycle at this point. So I don't know if this idiosyncrasy is going to pass over to the other economies at a time when pretty much the rest of the world seems to be doing okay.
In terms of, and then quickly here, of the trend of a weaker dollar, I mean, China to some degree wants a weaker yuan, right, for helping stimulate their growth?
Absolutely. I mean, if you look at the yuan this year, it hasn't budged much at all. We have seen like some 3% move in the dollar yuan rate. And if you look at the China fixing, the PBOC's own fixing is just down some 2.7% or something like that. So if they're going to rely on exports, which it is very clear that they need to do going forward to get that 5% growth, it means that exports have to be revived. Exports are in the doldrums as well. And if they're going to revive exports, they are going to have to weaken the yuan materially from here, which means that the yuan has to go to, say, 730 by the end of the year.
Ben, thank you very much for that. That's Ven Ram from our Bloomberg MLive team. And for more market analysis from Ven and the rest of the team, MLive Go is where you want to head on your terminal. This is Bloomberg.
Ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Sellers are less eager to sell in an environment where they can't get the best price, and certainly rising interest rates have made it harder to justify higher prices, and so there are fewer deals available.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
On the David Rubenstein Show, Peer-to-Peer Conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
Lots happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From business's most influential and instrumental.
America's economy needs a diversity of institutions. That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Kriti Gupta is in New York. Now on to some top stories that caught our eyes this morning. And before you think you've changed the channel to one of our general news peers, let me tell you, we are going to discuss weather and sports. Starting with the weather, Kriti, several thunderstorms hit the U.S. Northeast over the weekend, causing deadly floods and suspension of several airport operations. Then meanwhile, over in Europe, a sizzling heat wave is threatening to make the summer one of the hottest ever. Southern ports of the continent are expecting to see temperatures soar past 40 degrees Celsius, or if you're in the U.S., that's 104 degrees Fahrenheit. Of course, it is still cold and rainy in London, in case you were wondering. Now, still here in London, not having to deal with those temperatures, it was Wimbledon, the final. It celebrated Carlos Alcaraz's win at the tournament, defeating seven-time champion Novak Djokovic. The 20-year-old Spanish player is the second youngest to win Wimbledon during the Open era. And Kriti, how about this? For a 20-year-old, he has won $2.9 million by winning this thing. Though that being said, that was probably the cost of a pint of beer at Wimbledon, given inflation. But still, that's a lot of money if you're 20.
It is. I think it's a lot of money at any age, to be fairly honest. I think what's hugely important, though, is that final play was just incredible. He was down in that first set, so to come back and recover after Djokovic winning the following two sets is a really big deal. Danny, I have a fun fact for you, though. Carlos Alcaraz is the first in about 21 years since 2002 to win outside of Djokovic, Federer, Nadal, and Andy Murray. So really setting the tone for a new generation in tennis.
I'm not going to lie, and I don't know what's wrong with me. I actually cried when he won that game set
Totally
point.
natural.
I literally cried. Just also want to mention quickly, Lionel Messi. He is officially a Florida resident after finalizing his deal with Inter Miami. Kriti, I showed you the picture. He was seen shopping at a Publix in Florida. I love it. He's a man of the people.
Totally. His contract's set to run through the 2025 Major League Soccer season. And by the way, some folks expecting him and the kind of buzz around those games to fuel some of the inflation in that region, something we're going to be watching for, of course, on a market and eco level.
Yeah, ticket prices that rival a Taylor Swift concert. In other words, very expensive. All right, coming up, we're going to be speaking to Simon French, chief economist at Panmure Gordon. This is Bloomberg.
brimming with sensors. There's several cameras that look out at your world because we're mapping your physical world so we could put the content in there. There's several cameras looking at your eyes so we know where you're looking in your physical world. And that's a lot of data. That's a lot of very personal data. There's a number of other sensors on the device that are needed to make it work in the way it does. So we feel strongly that, first of all, people should know what these devices can do. And since we're at the beginning of the curve, let's work on the right guidelines and put those guardrails in place now versus letting it out of the bag and trying to rein it in, several years from now.
So what rules would you put in place, and who should make up and enforce the rules?
I think it's definitely a public-private discussion, but it's a very complex technology. So I actually spend quite a bit of time in DC talking to folks, saying, just educating them on what it could do. But I think first and foremost, the data that it collects, there needs to be an understanding, the user needs to understand the level of data that it's collecting, and then be the one who says where that data goes.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. China's economy lost momentum in the second quarter, missing estimates and ringing new alarm bells about this recovery. U.S. Treasury Secretary Janet Yellen says she's eager to build on recent improvements in U.S.-China relations as finance chiefs from around the world gather in India. Yellen speaks exclusively with Bloomberg at 8:15 a.m. New York time. And is it the end of an era? The dollar's recent drop has a bevy of strategists and investors saying a turning point is finally at hand for the world's reserve currency. I'm Kriti Gupta in New York with Danny Berger in London. Danny, a lot to digest on the geopolitics. We have Chinese data, we have the Russia story, and of course what that has in terms of a read-through for FX. But I gotta say, it's not that clear of a picture when it comes to today's trade.
It's not necessarily, and I think it's because, as you lay out, there's a lot of cross currents. We also don't have any Fed speak in terms of U.S. data. It's not that remarkable of a week. We get U.S. empire manufacturing today. That's kind of it. So there's nothing to necessarily guide or reframe investor expectations, again, especially without Fed speak. The euro is continuing its strength. It is trading at a February 2022 high at this moment, despite the fact the dollar may be struggling, the dollar gaining against some other currencies. Again, it's that continuation of the trade last week. Are we going to get it, or is it too far? Now, I have the markets blog, live blog in front of me, which of course is a great place to read some of these resources. So with that, Kriti, and with the European trade into the red, I'm going to hand it over to you.
Yeah, certainly something we're going to keep an eye on when it comes to the read-through of the FX space on stateside, especially on the dollar. But first, I want to get to a few other assets. NASDAQ futures outperforming here, but only by 0.1%. I think those cross currents, Danny, that you were speaking of, really fueling the idea that we don't actually have any real direction. Remember, the Friday bank earnings story kind of gave us a little bit of a lead that perhaps things are going okay in the U.S., but of course we are still waiting on those bank earnings tomorrow as well, which could change the game. We're going to dive into that later in the show. The bond market gets interesting as well, because now you are starting to see a few analysts and strategists on Wall Street come out and say, well, maybe those cuts that are priced into the market, they might just pan out as early as March of 2024, which, Danny, if you think about it, is not that far. The two-year yield retreating again, 472, down about 4 basis points. Now, you would think when yields come down, the dollar would be weaker as well, and I think against the euro, it is. But then you look against the offshore yuan, and you're seeing dollar strength. Net, the Bloomberg Dollar Index is actually higher. Again, these cross currents coming from China versus strength in the U.S. versus interest rate differentials in Europe, not giving us a clear picture. But I have to reinforce the China story here, because you're having this very clear read-through into the commodity sector. Copper, for example, down almost 3% on the day, really shows you the sensitivity to the growth issues there.
Well, let's dig more into the China story, Kriti, because its economy slowed more than expected in the second quarter. GDP grew at 6.3% year over year. The expectation was for 7.1%. Joining us now is Simon French, chief economist at Panmure Gordon. Simon, I guess it's hard to disappoint a market that never had any hope to begin with for China growth, but does this change anything for you?
Well, it's a difficult week, isn't it, for narratives, and therefore, to some extent, it's an outweighed data print because we haven't, as you say, got other major economy data points, central banks speak. But in terms of the narrative specifically around China, there was a bit of a sliding scale of the data against, the first thing that has to be said, quite easy comps in Q2 2022. So actually, it was always going to be an above-trend year-on-year print, even though it missed to the low side. But if you break down the component parts, decent strength in retail sales, still a bit of revenge spending, maybe not as strong as some had hoped, but 8% plus for retail spending suggested a decent amount of strength there. But it's further down the line items where you start to get into fixed capital investment, you start to look at youth unemployment data, where there are some more worrying signals around the overall balance of growth in the Chinese economy. And for an economy that has given, over the course of the last 15 years, 40% of the global economy's growth, and even this year, on lowballed expectations, probably about a third of global economic growth, it's a very relevant data point for how much aggregate output growth the world economy can squeeze out.
Well, a lot of people thought, look, if the China data is coming out this way, surely we're going to get large-scale stimulus. We haven't gotten it. I still see plenty of expectations that maybe at the end of this month, when we have the Politburo meeting, there we'll get it. Are you expecting large-scale stimulus coming out of China?
Not large-scale, because there is a delicate balance to strike here. Too much stimulus, and you start to have an over-weakening of the yuan, fears of capital flight, and also making the job of rebalancing the contribution that real estate has into the Chinese economy, about a third of overall economic activity. That is a stated aim of the administration, to try and reduce that and rebalance growth towards technology, towards new energy. I'm afraid overly stimulating a sector that is, all right, it's in the doldrums, but if you go back and play the old tunes, unfortunately those structural arrangements which you've got to put in place given the prevailing demographics and skill shortages in the Chinese economy, you're going to make that job more difficult. There's a delicate tug of war going on, and therefore, to your point on aggressive stimulus, doesn't lend itself to an aggressive policy response.
Simon, you use that keyword structural changes, and I think it's interesting that you talk about it in a Chinese context, but let's bring it to an American context here. One of the main stories we've been following over the last few weeks is structural changes in the American economy that are now leading to things like union negotiations and labor strikes across this country in an era where it feels like the consensus is that inflation is heading lower and in the right direction. Talk to us about the stickiness of wages. How much is that priced into these economic models?
Well, the first thing to say is, although we are seeing a spike on recent trends in terms of industrial disputes, both in the US and in Europe, you have to look at unionized membership. There's a lot of talk about, particularly from the Biden administration, about good unionized jobs, but union membership in the US is about 9%. Back in the late 1970s, it was north of 30%. So that reversal towards collective pay bargaining, pushing in a different inflation spread from labor over and above the price mechanism, I don't think is in anybody's central economic model, because they don't see, and I certainly don't see, that bargaining position transforming itself back to an environment we saw in the labor market models of the 1970s and early 1980s.
It's interesting that you talk about the 70s and 80s, because it feels like we're almost having a repeat of the 90s negotiations, a lot of those parallels being made. Simon, talk to us then about how these strikes and labor negotiations could potentially very quickly, from Detroit, Silicon Valley to Hollywood, translate into a much higher unemployment figure. Is that the metric of success when it comes to the Federal Reserve doing its job?
Well, I think you make a good point in terms of you've got to factor in the degree to which industrial dispute pushes down corporate earnings, actually does some of the job for the Federal Reserve in terms of deflating the momentum in the US economy, and the degree to which, the Federal Reserve, you'll never hear a Fed speaker cite that as either a target or indeed a contextual factor. Central bankers are pretty good at claiming responsibility for bringing down inflation as part of their own toolkit. They see that as an exogenous factor. There won't be too many people who are disappointed amongst the federal banks across the United States if that manages to squeeze out a little bit extra of that excess demand that has been the real Achilles heel to the Fed hitting their policy targets.
Simon, I'm going to be honest. All I really want to know is what 12 pounds a glass of Pimm's at Wimbledon is going to do to UK inflation.
Yep.
The prices were crazy. They were absolutely crazy there. I'm sure you watched. I'm sure you paid up for it. No, maybe
I did.
Not.
Well, I wasn't at Wimbledon, but I've done other sort of events in the UK summer season where take the cricket at Lord's, similar sort of price points. Look, they're inflated price always at these events. The one thing I'd say, this week we get a key inflation print out of the UK for June. 8.7 was the May print. We expect 8.2, perhaps even 8.1. That's still 350 basis point spread higher than the G20 average. Right. The UK remains, and you can see this in gilt markets, you can see this in equity markets, the UK remains an inflation outlier. We're going to be another month, I'm afraid, until we start to get a real downshift in UK inflation. But yes, to the point of a Pimm's or a pint or any of your drinks of choice, it's a very visible inflation upside that makes the UK an outlier amongst its major economy counterparts at the moment.
But is it also an outlier in terms of the ceiling the BOE faces in terms of hiking rates? We've seen the European economy, the American economy hold up relatively well, but the UK, it's been said much before, it has this mortgage pressure. Yep. So is where the BOE can go, is that much less?
Well, a shout out to your Bloomberg colleagues who did some very good analysis about 10 days ago on this. Looking at the short-term impulse from rate increases was actually quite stimulative in terms of passing on an initial spending power to savers before that mortgage refinancing cycle plays through. But that is about to inflect. And I've written quite a lot about the fact that the Bank of England need to be able to say, right, we've done 490 basis points worth of hiking since the start of this cycle. That is not going to play out in large part for another 18 months, 2 years. And therefore, a pause, analogous to the one we've seen in the US, in Canada, in Australia, and the ECB are sort of gearing themselves up for, has to be part of the MPC's thinking. The problem is, they're still printing a CPI north of 8%. Very difficult to carve out that rhetoric when you've got a print that looks so different to those other major economies.
Around the world in 8 minutes, Simon French takes us through it all. Simon French at Panmure Gordon, thank you as always. Coming up, we're halfway through big bank earnings in the United States. We're going to get a deeper look from two true experts. Stick with us. This is Bloomberg.
London will stay a financial center. It will stay our EMEA hub. We'll just have a rebalancing onto the continent. And actually, the numbers of who has moved across aren't that big. So it's sort of in the 200 level. And if you think about 15,000 people, that's sort of not that material. And so I do think both will basically continue to grow and continue to be very relevant. What will change, though, and the big thing that's changing, is actually the risk-taking is what's going to move. And so we've historically had risk-taking in the UK. That risk-taking and the assets that go with it, not the people alone, but the assets that go with it, that's the next phase of what we're now moving into. And that will be a material change.
Three prime ministers, 4 chancellors, an energy crisis and the soaring cost of living.
It's been a hard year for startups, but even in the toughest times, some of the best ideas are born here in the UK. Bloomberg UK's Startups to Watch will profile the brightest companies under 10 years old, with the winners unveiled at the Bloomberg Technology Summit in London in October. Get your entry in by the 7th of August for the chance to have your company profiled and to attend unique networking events. Good luck, and we hope to see you there.
You're seeing the benefit of higher rates, and I think we positioned our balance sheet to get the benefit of this over the last few years, and it's coming through as we expected it would. Now, as you look forward from here, you're certainly going to have more challenges as you look at consumers continuing to spend, which is drawing down some of the deposits. You're seeing rates potentially get closer to a peak. And so a lot of those factors will drive net interest income over the coming quarter.
The CFO of Wells Fargo speaking there to Bloomberg after the bank earned more net interest income than analysts expected in the second quarter and lifted its guidance for the full year. Bank earnings continuing this week. Morgan Stanley, Bank of America report tomorrow, followed by Goldman on Wednesday, plus a host of regional banks to come throughout the week. For more on this, we're joined by Allison Williams and Herman Chan of Bloomberg Intelligence, two of the brightest and best, I must say. Allison, I want to start with you here when we're talking about simply what we actually learned on Friday. Some pretty decent results coming out of JP Morgan, Citi, and Wells Fargo. Is the bank turmoil that we were worried about 6 months ago, are we in the clear?
I think, in terms of the actual turmoil, we are in the clear. I'll let Herman chime in a little bit more since that really involves some of the regional banks. But I mean, the broader issue in terms of, the portfolios and the impact of rising rates is something that we'll deal with for a while. But I think that the bottom line for the big banks, you saw the better net interest income. I think it wasn't a huge surprise. The banks were all sort of running ahead of plan or ahead of guidance, if you will. In the first quarter, I think they were just very conservative and hesitant to up the guidance. And now it was a lot tougher to do. JP Morgan did up their guidance, but they had to up that again. And I think what we're seeing there, two key things. So one is for my banks, the credit card business. That is where you're seeing the loan growth across the industry. So while loans are flattish, commercial and industrial down, card is actually holding up pretty well. It's the higher yielding part of the portfolio. And so that really is helping Citigroup and JP Morgan that really have outsized exposures. Also Wells Fargo that has done a good job growing in that area. And then the second thing is the cost of deposits. So we have seen that obviously coming up. We had the big benefit in 2022 to the yield part of the equation. Now we're seeing the costs going up, but those costs came in, I would say, less than feared. So costs are going up. Deposits are still continuing to migrate to higher yielding alternatives. They are migrating to money markets, but perhaps not to the extent that some had been afraid of.
All right, Herman, your turn. Allison kind of laid the groundwork, basically saying, look, there is a lot of strength in these bigger banks, a lot of it led by the consumer. Talk to us about the regional bank story. I know you have your eye on PNC Financial, which I should add was one of the bidders, if I'm not wrong, for right. First Republic as well. How are they faring?
That's right. So we are seeing some of the same issues that Allison articulated earlier. The fallout is really recurring for the regional banks, where you're seeing the higher cost of deposits, which is really, for the regionals, upending the revenue equation. We're expecting revenues to come down across the board for the regional banks because of the higher funding costs. And Allison articulated higher credit card lending, whereas the regional banks really don't have that aspect into their loan books as much. So you're going to see some flattish or actually declines in the loan portfolios for the regional banks. We're expecting fairly strong results from PNC relative to the group because they just have a bit more flexibility from the deposit perspective and also a broader reach from a geographic perspective because they just recently bought BBVA on the West Coast. So they've got a bit more levers to pull versus the typical regional bank.
Herman, are you expecting any more hints of consolidation within regional banks this reporting season?
Yeah, that's the big question. We should be able to see, ideally, some consolidation across the board for the regionals because of just the tougher revenue backdrop, higher regulations, and potential credit issues down the road. So in theory, you should expect to see consolidation across the industry. What's really affecting that notion is that the regulators have all, for the Biden administration in particular, have had a tougher eye on regulation because they're focused more on competition. So if the regulators loosen up a bit, then I think you could see some consolidation down the road.
No, that's a great point. And Allison, we had all of the banks post-stress tests release more investor payouts, but we're still waiting for things like Basel III reform. Is there going to be more headaches when it comes to banks, especially in their ability to return shareholder capital because of what regulators propose?
Certainly, the Basel III endgame rules are the thing that we're waiting for the big banks. The news on the stress test was positive for most banks except for Citi. I should note that Bank of America and Citigroup both do have ongoing dialogues with the Fed, just trying to understand a little bit more transparency behind the results and why they were so different from some of their own internal projections. But Basel III endgame rules, we've already seen sort of some of the outlines of the proposal. We've had many hints in the press, but that really is going to be one of the key factors to decide how much capital flexibility the banks have. And to be clear, when we look at some of the headline numbers and some of the scenarios thrown out there, the banks have the pre-tax profit to certainly meet these higher standards, and there will be a phase-in period, but it will be a constraint.
Allison, talk to us then again about kind of where the banks go from here over the next few quarters, assuming that tomorrow we get a similar broader message that we got from the likes of JP Morgan, Citi, and Wells Fargo. You mentioned a lot of the growth was kind of led and bolstered by the credit card story. In past quarters, a lot of it's been bolstered by trading volume. Where did the trading volume go? Where might it go in the next few quarters?
So in terms of the trading and fee revenue has come in weaker. So it's a little bit better than perhaps the bar was lowered with a lot of the comments in June and the like. But I think it's really sort of a tale of two revenue streams. So trading is coming down, but really within a historically higher range and very profitable. And we do think that on the fixed income side of things, you will still get a lift on the rate side just because of the uncertainty. We're in an unprecedented environment. We think that continues to drive a lot of volatility and activity. Also this year for the banks, and certainly you're seeing it in the quarter, the credit trading side of things, which was very weak last year, just coming off of some weaker comparisons. We're getting some issuance finally, so that's helpful on fixed income trading. Equity trading, weaker, but again, still within a historically high range. And then the other side of the equation is fees, and that's, I think, where you're really seeing things normalizing, but at pre-pandemic levels, so at a much lower pace. And I think that's where you're seeing a lot of the headcount talk, and that is to some extent the banks saying like, okay, we're gonna start to right size to this new reality. We had 2021 was an amazing year, a lot of records broken for M&A and equities. Last year, I think the banks were hesitant to cut because it was such a scramble, as you recall, in 2021, especially for the junior bankers. And so now we're starting to hear talk of those cuts. We are seeing some green shoots in equity underwriting, definitely a pop this quarter, but the M&A headwind is just really hitting the banks this year.
Herman, for the regional banks, what about the office commercial real estate headwind?
Yeah, so that gets a lot of headlines. For the regional banks that I cover, it is something that is in focus, and we should hear more about how things have deteriorated in the first quarter, but in the second quarter. But what brings us comfort is that the exposures themselves is still fairly low for the largest regional banks in the United States. It's about 2-3% of the total loan book. Underwriting's been historically very conservative. We're talking about a loan to value ratio in the 60% range. So there is a lot of cushion involved before you get any potential losses. We do expect losses down the road, but it should be fairly manageable for the group.
Allison Williams and Herman Chan of Bloomberg Intelligence, thank you as always. Waking up early and giving us that crucial insight, we thank you as always. Now coming up, a look at some of the other market-moving events and stocks to watch today and throughout the week. We're already seeing some of the Euro stocks futures gains getting paired here and really having a read through to U.S. futures as well. We're going to dive into it. This is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
In many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
The names that move markets are on Bloomberg.
Concentration in industry after industry after industry is a threat to our economy. It is a threat to innovation, and ultimately often leads to price gouging, whether it's consumers or the government. I believe in the power of markets, but they only work if we enforce the rules that keep competitors going rather than monopolists.
Nobody covers business like Bloomberg, your global business authority.
This is Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Kriti Gupta is in New York. The sell-off in Europe is picking up with some pace. Luxury goods makers are really leading this. Richemont had earnings. Huge disappointment when it came to the American consumer revenue in the region, dropping 2%. The estimate was for a gain. It's that, Kriti, plus the China data dump, which showed fears around any sort of economic momentum. ASML also falling on China news after the close on Friday, news that ASML would face tougher restrictions when it came to China exports.
Yeah, and having a real read through into futures as well. You are seeing S&P futures down about 0.1%. Doesn't sound like a lot, but you are seeing quite a big move. I want to get back to some of the stocks that are moving in the pre-market. For example, Microsoft, Activision shares are rising. The FTC had lost the appeal, but you are also seeing Activision get that $10 billion or 10-year agreement, I should say, with its counterpart Sony in Asia, that fueling Activision futures. You are also seeing Paramount as well. They are falling on that box office miss, but their parent company in talks with creditors and United also finally reaching an agreement with their pilots. So a lot to digest, a lot of micro moves. I'm sure Surveillance and the other shows will walk you through it. Stick with us. An exclusive interview with Janet Yellen coming up on Surveillance, 8:15 New York time. Stick with us. This is Bloomberg.
Venture capital, it's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others.
Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
We are on track for a soft landing.
Even if storm clouds do materialize on the economic front, we think that's still a ways away.
What it comes down to right now is the inflation picture.
We feel quietly confident that by 2024, we're not going to be worrying about inflation.
We should get to a point where we see a mild and shallow recession towards the end of the year.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Let's get your week started. Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Your equity market slightly negative on the S&P 500. Going into earnings tomorrow from Morgan Stanley, Bank of America, onto Wednesday from Goldman Sachs. Tomorrow morning, too, U.S. retail sales. One to watch this morning, Secretary Yellen, the Treasury Secretary, sitting down with Bloomberg's Anne-Marie. TK, that interview in about 2 hours from now.
Incredibly well timed to speak the Secretary of Treasury here, not only off the Chinese report of some lessening of growth, I'll call it. We'll get to that in a moment here. But it's a time where we have finance and investment dovetailing into each other, and that's a tension of this bull market that a lot of bears are trying to get used to.
And election campaign slowly building.
A little bit of politics in there as well, yeah.
Starting to feel that, Bramo, a little bit more going deeper into July.
Yeah, especially as we got over the weekend some of the totals with respect to campaign finance for the Republicans, and it really showed a lack of a consolidation around any not Trump candidate, which is sort of interesting. Also, DeSantis really burning through his cash. But yes, to your point, it is getting crowded. It is heating up. How much oxygen do we have left for another candidate to come in on either side?
Going into that first debate in August, let's talk about a market that's potentially getting crowded. 4-day winning streak on the S&P 500 last week snapped on Friday, but still a decent week of gains on the S&P. A week of losses for the US dollar. Dollar weaker, TK. We're now looking potentially at 8 days of euro strength against the US dollar. You've got to go all the way back to July 2020. For June 2020 now, Tom,
right.
For moves like that.
And I usually don't go to the euro, John, but I'm going to agree with you today that you have to go to the euro as a litmus paper of the global system. This is the deepest market. It redounds back over to bonds, to an extent over to equities as well, touched by the earnings story. But at 112.41, when do we round that up to a shocking 113? The people that went long, strong euro 115, they're the geniuses of the moment.
Well, Alan Ruskin at Deutsche Bank was looking for that move to 115, and he now says maybe that could even happen even faster. Let's check out the price action right now. This Monday morning, futures just a little bit softer on the S&P. We're negative by 0.1%. Yields down again. Weak data out of China. We'll build on that. We're down 6 basis points. Your 10-year 377.35. And there's the move in the euro that Tom's talking about, Lisa. 112.43 on the euro against the dollar.
It has been one of the most consistent moves that we've seen over the past few weeks, and how much oxygen does it have left at a time when the dollar is creating this existential discussion in some corners. Today, the G20 finance ministers and central bank governors are meeting in Gandhinagar in India. And this, to me, comes after that Chinese data that was so interesting. How do they dovetail growth versus some sort of reining in of inflation? Janet Yellen, the U.S. Treasury Secretary, as you were mentioning, John, will be speaking in an exclusive with our very own Anne-Marie Herdern at 8:15 a.m. this morning. What she says both about global growth as well as China will be key. 8:30 a.m. we get July Empire Manufacturing. How much do we see that continue continued upside surprise in the good data, as well as downside surprises in the inflation data, the perfect mix that led to a lot of the enthusiasm last week. And today, the regional bank earnings kick off, and this comes ahead of Morgan Stanley and Bank of America tomorrow, Goldman Sachs on Wednesday. We get a slew of regional banks, FB Financial, Home Bancorp, CrossFirst Bank Shares. You've never heard of any of them, but we are looking to see if the lending has slowed materially, what their cost of deposits really is, and the commercial real estate portfolios on their balance sheets, John.
There are many of those banks I've never heard of. I admit.
I could give you some more. Guarantee Bank Shares,
sure.
Southern California Bancorp, Bank First Capital. They all report today.
Okay, we're looking forward to that. Bramo, thank you. We caught up on Friday with Mohammed Al-Arian. This is what he had to say. You cannot get in the way right now of the soft landing narrative. Let's talk to a house that is constructive on the equity market. Luke Cower, asset allocation strategist at UBS Asset Management, a good friend of ours. Luke Cower, good to see you this morning, buddy, as always. Luke, why are you still overweight equities over the team at UBS?
I think you mentioned in the intro the idea that this is becoming a more subscribed idea, and it is becoming possibly a more crowded position in equities. Our view is really that the path to the soft landing has widened so much that it can accommodate this crowd a little better. Just there's just more room for traffic, more lanes on this highway. It's very important to us that we've now seen a pretty marked deceleration in core inflation, in some of the more underlying super core inflationary metrics. You can say it's just one print, it's just the June CPI, but in the eyes of investors, I think you have a lot of confidence that we've slayed the inflation boogeyman and we've slayed the recession boogeyman at the same time, and that's because they were very interlinked. The inflation problem was a big drag on real incomes, hurting real consumption, and through the potential financial conditions channel, inflation was something that was causing central banks to be on track to keep policy tight for longer, but increasingly tighter for longer. And in our view, this risk has receded somewhat, and that's very important. So we can move from a world in which in 2022 and part of 21 we were really relying on excess savings to paper over the hit to real incomes. Now it's real incomes that are going to allow for a measured but still very positive and decent growth in consumer spending going forward.
As we waltz through Luke Kawa economics, we have to make choices in sectors. The key thing with the sectors is we broaden out the market. Does UBS see evidence that we are broadening out from the off the bottom October bull market condition?
I would think certainly, and I would also add that even when the U.S. market appeared narrow, that was still occurring in the context of European equities still doing quite well. That was occurring in the context of Japan breaking out to a fresh 30-year high. So even the narrowness of the U.S. market wasn't necessarily speaking to a narrowness of the global equity rally. But in our view, what's changed and why we really want to be selective about what we like, and what we like is the many in U.S. stocks, because that's where the resilience in the global economy is. And think about right now, I'm sure we might get to the disappointing Chinese data. On disappointing Chinese data, you would normally think you'd have a much larger spread between NASDAQ futures and S&P 500 futures than you have coming into today. And I think that's a testament to the expected earnings resilience of the many in the U.S. equity market. And even as we have a higher bar to clear this earnings season, it's a bar that looks actually a lot more similar to a pre-pandemic environment than it does a inflation shock environment or coming out of the pandemic.
There's a lot to unpack there, Luke. Just to follow up on what you were talking about with the data out of China over the weekend, are you saying that it's not going to be as impactful for a lot of the U.S. companies that are multinationals that do have big footprints in China? Or are you saying that that's already been discounted in the share prices?
I would say largely the former. The bad news about China is that China's clearly lost a lot of reopening momentum sequentially. That's very, very abundantly clear in the data that more support will at some point be needed. The good news from our point of view is that this cycle, we haven't been nearly as reliant on the ebbs and flows of the Chinese credit impulse, of Chinese policy for global growth and global earnings as we have been in let's say the 15 years prior. So that development means I think you're seeing a lot of the classic cross-asset correlation still kick in this morning with, you know, the Antipodeans, with, you know, for instance, commodities still doing poorly. But how interesting is it, Lisa, that you have, you know, the dollar pretty much flat on a day with, you know, pretty disappointing Chinese growth data? I think that speaks to the idea that global growth can remain in a positive, though, you know, not gangbusters and certainly decelerating state, even with China really not having its foot on the accelerator at all.
It also might speak to the power of narrative, because this market seems to be driven by the narrative and the mood shift of the moment, and suddenly people are back in. Everything is awesome, and we are getting this soft landing kind of narrative. We are expecting a 9% drop in profits from S&P companies as they report earnings over this quarter, over the next few weeks. A lot of people are saying that's priced in. What would it take for you to change your view, for you to say maybe there is more weakness under the hood than some people are considering?
Well, first off, even on that 9% drop in profits, that's disguising a, you know, expected 1%, you know, small, but 1% advance year over year from the median company and S&P 500 earnings. I would think that, you know, one thing we've seen recently has been a pretty big recalibration in terms of how we've approached earnings season, in terms of estimates really weren't cut that much coming to the season relative to previous ones, and pre-announcements were, you know, generally more positive than they have been. I think if that guidance outlook takes a turn for the worse, then that's something that, you know, we have to be cognizant of. Because even if you have an expensive equity market, and, you know, at the market cap level, the S&P 500 certainly is, at the equal weight or mid cap level, we would, you know, argue that it's still actually relatively inexpensive. But if you're looking at, you know, 3 months, 6 months, 1 year performance, the expensiveness of the equity market is not as important as whether earnings estimates are rising or not. And, you know, for us, that's going to be the key, just to make sure that this kind of nascent better trend we've seen of the, you know, bottom up reflecting our macro view of a widening path to the soft landing, if that were to come into question, then that's certainly something that would get us to reevaluate our position.
So, Luke, let's just work through the base case right now. Strip out the muscle, the dominance of big tech from your portfolio, shift to equal weight, shift away from mega cap tech. Is that right? Where does Europe International fit into that backdrop?
On the Europe and international side, I think what we've had is, you know, some capacity now for the Japanese story is obviously, you know, very strong, and we do enjoy the idea that Japanese equities are benefiting from some idiosyncratic catalysts in terms of the massive kind of change in attitudes to the shareholder return programs there. You know, however, I would also say that, you know, European equities, from the standpoint of having gotten you know, still doing pretty well, but having, you know, surprises be quite negative, have the euro make quite a run. If the euro continues to appreciate, obviously that's going to be a headwind to European equities. But, you know, in our view, the idea that the U.S. dollar is going to weaken permanently on U.S. disinflation, rather than the disinflation story becoming more widely spread and U.S. still having that relative growth, resilience, and probably a relative real rate advantage, that's something that, you know, creates a bit more of a potentially range-bound trade in the dollar, offers a little more support, and does take some of the potential negatives out of the way of the international equity sphere beyond that.
Dollar a touch weaker this morning. Luke, as always, buddy, it's good to see you. Luke out there of UBS Asset Management on the international story. Looking for this rally to broaden out over at UBS with Luke and the team. This is what we're seeing right now on the screen. Disappointment on the luxury players in Europe this morning. Richemont getting absolutely slammed in Swiss trading by about 9%. MS down by about 4%, LVMH down 4% as well. We're off the highs of the year so far. TK, Richemont coming out with earnings a little bit early this morning, just a bit softer than expectations, but that really lit a fuse for this sell-off.
Bloomberg Intelligence does great work on this. I'm just voicing what they say, and we say luxury, but they partition that to be polite into 3 groups, if not 5 groups. And they've got the elite, the names we quote all the time. There's a middle pack, and then there's a sort of kind of like luxury as well. Their suggestion is, with the Chinese worries, at the minimum it affects the middle group and certainly the lower group. Jury's out on the super luxury.
Can you rank
names.
Richemont where the brands Cartier and Van Cleef fit
I'm not up
into your
to speed
ranking
on
of luxury?
Richemont. I'm not. They're Cartier.
Cartier.
Yeah, I'm
Van
just
Cleef.
not Van Cleef. They own Van Cleef.
Found yourself in there a few times, I'm sure. Is that high-end luxury for you?
It's a high-end entrance. The door at Van Cleef is so small, I almost have ducked to go into it. It's like something out of the 19th century.
One day you've got to do your review of the jewelry stores on Fifth Avenue.
We should do that.
We can do that another time. Mislav Matejka at JP Morgan this morning on China, for those of you interested. Take a listen to this. The region is sliding back into deflation. The property market will likely need a much more aggressive policy, Tom, aggressive policy support to rebound sustainably. Given past excesses, we stay cautious on China.
Others are more optimistic, but they both agree the key thing here for the United States is the price change metric in their slowdown. And you mentioned that in the first sentence with the worry of disinflation, if not outright goods deflation in China.
Next hour, Michael Schowell of Market Field Asset Management. A quiet start to the week. It picks up from tomorrow with US retail sales in the morning. Tons of earnings too. Lisa's gone through that for you on the regional banking side. The bigger banks on Wall Street, they return tomorrow with the likes of Morgan Stanley and Bank of America. Then on to Wednesday with Goldman Sachs. Then next week, we start to talk about big tech all over again. Futures on the S&P, just a little softer. Good morning.
multi-trillion-dollar industry. There's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacroix, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
From New York City,
From London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching. You do not want to miss this story.
Is there the kind of upside?
Earnings season is here.
You're going to see cracks start to emerge. This earnings season could be a little bit choppy.
This is going to be an earnings season mystery.
Bloomberg breaks the numbers first.
Those earnings just crossing the wire.
Up by 25%.
Absolutely blew out of the water expectations.
With exclusive expert analysis.
We're starting to see earnings recovery emerge.
AI will be a huge boost of revenue growth.
You're not going to see the same follow-through in terms of the price reaction.
Second quarter will be where the rubber meets the road.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
The Fed, several times in the last several years, including when I was there, got burned when they looked at data that was improving and extrapolated that. So I think this committee will certainly be wary of declaring mission accomplished and victory. I think a softish landing with some slowdown in growth and some modest rise in unemployment is what the Fed is aiming to achieve. The Powell Fed will keep at it, as they've said, until the job is done.
Always good to hear from Richard Clarida there, the PIMCO Global Economic Advisor and, of course, former Fed Vice Chair, mentioning that he thinks perhaps it's sensible to price in a rate cut in March of next year. TK, I'm sure you love that kind of commentary around the Federal Reserve, but ultimately that's what some people are looking for, maybe a reduction from the Federal Reserve. Bear in mind this week, no Fed speak. That's the good news for you. Into the quiet period. Next week, a Federal Reserve decision. Most people assuming they're going to hike interest rates, Tom. The unknown is beyond July, going through the summer and out into September and beyond.
Guess what? Their ex-posts are going to wait for the data. The data matters, the retail sales matters, and then on we go. Annabelle, I like, let's remember it's July 17, I believe is the date today. So we're dashing, say, 2 weeks away, 2 long weeks away from a jobs report from ISM in August. And that's what they're going to do. They're going to wait for more data.
Tons of earnings in between as well.
Yeah, and the earnings are not a small matter. I believe Apple August 3rd.
Get that one in the diary.
Have to
or the
see.
journal. Or the calendar.
We're going to digress we're going to digress right now.
It's on the calendar.
Yeah, it's on the calendar. You know,
or in your diary.
I think I'm taking all of August off. Joining us now is a gentleman who knows what a town meeting is in New Hampshire. Long ago and far away, Grandpa Vellier took the grandson off in the LL Bean boots and, you know, the plaid shirt and all that. They went by canoe in New Hampshire to the local town meeting. Nobody going by canoe today, this middle July, to see Manchin of West Virginia and Greg Vellier's New Hampshire. Mr. Vellier joins us now, Chief U.S. Policy Strategist at AGF. He's never recovered from that rock up by Bretton Woods falling off the cliff. Greg, you know New Hampshire like anyone we speak to. What is the symbolism of the gentleman from West Virginia in the Granite State?
Well, it's fascinating. And by the way, Tom, when I was a little kid, my dad took me to see John Kennedy. I shook John Kennedy's hand. That was quite an event. But,
very cool.
But a lot of politicians make their bones in New Hampshire, and Joe Manchin is aware of that. So the big political story, and there have been many, the DeSantis collapse, the Robert Kennedy gaffe, but the big story today clearly is going to be Joe Manchin, the maverick from West Virginia, going to New Hampshire for this group, no labels, indicating, I think, teasing a possible presidential run.
Inform our audience, particularly our international audience, what form of maverick is he? I understand that Professor Carter of, I believe, Harvard is to the left of Bernie Sanders. Where does Manchin sit, right, left of the President of the United States?
Clearly in the center. I think he feels that the Biden administration has spent too much money, has been reckless on a lot of domestic policies. So he's a centrist. He feels there's a road there, a path, and there may be a path. I'm not sure he's going to be the nominee, but he could stir things up and weaken up Biden for the general election.
Well, that was what I was going to ask, Greg. Who would he weaken more, Joe Biden or whoever is going to win the ticket on the Republican side?
Well, I think if I'd say Joe Biden. I'd say if Manchin gets 20 or 25%, and I don't think Robert Kennedy is going to get much after this weekend, then I think that could hurt Biden a little bit. But at the same time, if he really campaigns as a centrist, as a third-party centrist, he could do well. Not well enough to win, but certainly well enough, again, to hurt Joe Biden.
There seems to be, in the zeitgeist this morning, a discussion about Ron DeSantis and whether his campaign is doomed, especially given how quickly he's been burning through cash and his lack of investments, lack of contributions from smaller contributors. Do you agree with that? Do you think that there is a path for some sort of resurrection and getting back his momentum?
I think he is going to campaign in all 99 counties in Iowa. I think he has to take Iowa much more seriously. He has indicated he didn't want to join the debate. No, he has to join the debate. But I think that right now, the lead is about 40 points around the country for Trump over DeSantis. That's a really big lead.
Meanwhile, another news item that really caught our attention over the weekend was UPS and some of these strikes that have been ongoing with the workers. They haven't yet declared strike, but they are heading to that deadline and are looking likely to reach that level. There are a slew of other strikes. UPS, the workers have asked Joe Biden's administration not to intervene the way that they did in the rail strikes. From your perspective, why is it that we're seeing such a slew of strikes and union activism over the past couple of months, and what are the implications for the U.S. economy?
Well, to me, it's the sleeper of the late summer, Lisa. First of all, a lot of workers feel that their salaries are not keeping pace with prices of housing and food and gasoline, things like that. So I think that there's an economic argument for it. But, you know, it's not just Hollywood. It's UPS. It's the United Auto Workers who are making noise. They could go on strike. And it is Southern California, housekeepers at hotels. And the Hollywood strike has had a ripple effect on Southern California. So I think this is going to be a real sleeper to see if Joe Biden gets actively involved.
Yeah, Greg Vellier, my shock of the weekend, and whatever anybody thinks of his politics, pro-con, I really don't care about the political debate. But the fact is, the public service of the former Vice President of the United States, Mr. Pence of Indiana, is noted. I was stunned at his inability to raise money. Were you surprised?
Absolutely. It was a really weak number. There aren't many candidates who can say, I did great. Maybe Tim Scott of South Carolina, but the performance by Pence, you're right, Tom, was a real surprise.
Let's finish on that, Greg. Next month, there is a debate on the stage. May or may not be the former president, Donald Trump. The former governor of New Jersey, Chris Christie, put out an ad over the last week, basically calling the former president a chicken for not turning up. Now, Greg, from your perspective, do you believe that the former president will be on that debate stage come August?
Knowing his love of publicity, I would say yes, John. I think he couldn't resist getting involved in this. So he'll be persuaded to join the debate, in my opinion.
Greg Valliere of AGF Investments. Greg, thank you. Just a month away, TK. Next month, Fox News, I believe,
soon.
hosting there a big Republican field.
I just yearn for, well, Wimbledon's over, so let us move on to the 6-day battle for the election in the United Kingdom. It's ridiculous. But with that said, all of a sudden this weekend it became more interesting when there's some real challenges there about fundraising and signatures and the rest. I can't say I really read into it over the weekend. We rely on a guy like Valliere to do that. But there were some surprises this weekend politically, no question about it.
You can see arguments for and against the idea that the former president attends that if you're on his team. Can't you, Bramo? You can see reason why he wouldn't. Just let them fight between themselves. He's got a decent lead in the polls right now.
So here's his response to it exactly on a Sunday morning Futures on Fox News over the weekend. He said, so you're leading people by 50 and 60 points, and you say, why would you be doing a debate? It's actually not fair. Why would you let somebody that's at 0 or at 1 or 2 or 3 be popping you with questions? So that's his response to the chicken comments from Chris Christie and just in general why he may not show up.
Why should he give them a platform? I guess is his perspective, right?
At the same time, it is incredible publicity, and his absence could be construed as differently than perhaps he would like. So this is the key question, especially if Chris Christie is going to have such a taunt. And that's basically what he's being paid for. That's basically what he's getting raised. He's raising money.
That's like his role.
His role is to put out this stuff, basically mocking the former president.
Somebody came up to me this weekend and said, who is Mohammed El-Arian? They weren't disparaging of Dr. El-Arian, but they said just, it's like Butch Cassidy. Who is this guy? And he wrote an essay, John, here in the last 24 hours for Bloomberg, which completely encapsulates El-Arian. It's about game theory and how we play in the time continuum. And this is just absolutely brilliant of the moment. Right now, we're playing in the equity markets of what hasn't happened. That's a really, really important insight.
I had the pleasure of talking about some of this with him on Friday, Tom. Do you want to tell us where you were when that person came up to you?
On Friday, where was I? Some McDonald's.
Sure. Okay. Kelsey Barrow, JP Morgan, up next.
best investment advice you've ever been given by anybody?
The compound interest, the compounding of returns is an incredible miracle of business, finance, and human existence. Everything you learn is additive every day, and if you keep at it and don't quit, it's an incredible miracle. And it's not just interest. It was always said about compound interest returns, compound business returns, compound human returns. They're all very additive because you learn every day. And if you keep at it, it's very, very helpful.
In your observation of investors, what do you think is the biggest mistake that average investors make?
Selling at the wrong time.
And they sell when the prices go down?
Yes. Yes. Not keeping, look, people have conviction, or they invest for if they invest for the right reasons, just keep at it.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Monday morning, good morning. Equities just a little softer, negative, lighter, lower, down on the S&P 500. Futures off by 0.1%, snapping a 4-day winning streak last week on Friday with a muted move lower. Really mild stuff on the NASDAQ too. We're negative by 0.03%. Weak data out of China overnight. Cuts to the forecast for Chinese growth. Look at this. Citi, cut. Morgan Stanley, cut. JP Morgan, cut. SocGen cut to 5% from 5.5. And how's this for a quote? This can only be achievable if the government continues to step up easing measures. So 5%, Tom, it's 5%. And apparently, according to SocGen, it needs some stimulus.
There's going to be some really interesting discussions here, and you really can't watch renminbi as the litmus paper. You have to watch the policy prescriptions out of Beijing, something that maybe Anne-Marie will discuss with Secretary of Treasury Yellen here. I thought that